Okay, so remaining part of the budget. So the first one is Bharat Vistar. So it is virtually integrated system to access agricultural resources. That is Vistar. Virtually integrated system to access agricultural resources. Now, one problem with respect to our agriculture sector is lack of proper extension services. And that too customized extension services. So there are different agro-climatic regions, different crops, it need different requirements, customized service. So an integration of AgriStack with research is basically the idea behind Bharat Vistar. So it connects two major aspects. One is AgriStack, there is a government database containing farmers' profile, land and crop details. Farmers' profile, land details, crop details. The fundamental aspects required for a farmer, AgriStack, and this will be merged or bridged with another key aspect, that is agriculture research by ICAR, Indian Council for Agricultural Research. So combining these two, government is trying to provide a customized information to the farmers. So farmers can get the details through their mobile phones, because farmer details are there, land details are there, the crop details are there. Now ICAR conducts research. Now what is needed is, depends on the farmer's land. For example, if there is an issue, if there is some new disease or something, then what is required? Farmer should know what is the ideal solution for his land, his crop. So he can look into through his mobile phone, or he can simply call a toll-free helpline, that is 155261. 155261, a toll-free helpline. So then they will get a personalized, customized opinion or advice regarding his land or crop problem. So that is basically the idea. And it is also a multilingual AI, so it can speak in the local language. So it will deliver the information in the farmer's local language. Sandhya, ye band karna. Farmer's local language because of multilingual AI. So that is basically the idea. It incorporates AgriStack with the ICAR, Indian Council of Agricultural Research, which is having various research practices, and it will give the input based on the farmer's land or crop details. That is, these are all part of Digital Agriculture Mission. So that is the key aspects here. Now the MCQ traps, first one, Bharat Vistar is a newly launched direct benefit transfer scheme. What is the answer? It's a multilingual AI advisory tool which provide customized information on farming practices. Under Bharat Vistar initiative, government aims to integrate physical APMC mandis. What is the answer? Very good. Next one is high value crops. Another problem with respect to India's agriculture sector is focus on quantity, volume over value. So traditional crops, our farmers generally focus on traditional crops like wheat, paddy, rice, this kind of crops. Now what is the reason for farmers focus on these crops? That is because government's support. Government support, what sort of support? MSP plus procurement. But what happened because of this focus? There is a kind of challenges with respect to enhancing the productivity. Overall production and productivity is almost stabilized. Now, if you want to increase the income of the farmer, then you cannot increase the income from the traditional crops. You cannot double the farmer's income by focusing on increasing the production or productivity here, because government will have to support more. There is also negative externalities related to subsidy. Negative externalities related to subsidy like water, groundwater extraction and things like that, environmental. So government is saying that now focus more on high value crops, thereby increase the income of the farmer. So increase the income, that is one thing. Second, another problem with respect to India's agriculture sector. What is the time? Yeah. Who said that? Very good. Another one problem is we are having an import dependence on some of the high value crops. Now what is the problem when we are having an import dependence on high value crops? Weaponization, okay, weaponization and things like that, but cashew nut and all, how much they will weaponize? Forex, okay, foreign exchange reserves. So that is another challenge, because if you want to import, then you will have to spend a lot of money. So rather than giving that money outside, spend that money domestically. So government is focusing on some high value crops in targeted regions. Targeted regions. So in coastal areas, this is important. Coastal areas, under the budget scheme, coastal areas will focus on coconut, sandalwood, cocoa and cashew. These are the coastal areas focus. This is important. And India is also world's largest producer of coconuts. But one problem with respect to our present coconut plantation is low productivity. Low productivity, old plantations and low productivity. So government also come up with a coconut promotion scheme to replace the old unproductive trees with high yield varieties. So coconut, sandalwood, cocoa and cashew, these are coastal areas. In the hilly regions, it will focus on almonds, walnuts, pine nuts. And northeast India, it will also focus on agar trees. Agar trees are also used in luxury perfumes, incense, all those areas, agarbatis. Okay. So agar trees in northeast India, hilly region, nuts, almonds, pine nuts, walnuts, these things. With respect to India's processing, we are having massive processing facilities, especially cashew and all, we are having processing. So similar to our oil infrastructure, we are having large refineries, but what we need? We need to import crude oil. We are having large processing units, but what is the problem? Domestic production of cashew is not there. So you will have to import, process it and export. So that challenge is there. So we are also focusing on making India cashew and cocoa premium global brands by 2030. So these are the things. Question: to reduce India's massive import dependence on coconuts from Southeast Asia, Budget 26-27 launched coconut promotion scheme. We are already the largest producer of coconuts. Our problem is not lack of coconuts but low productivity and old plantations. That is the reason. Under the High Value Agriculture Initiative, government aims to boost the cultivation of agar trees in the coastal regions of Kerala and Tamil Nadu. Next is rural employment. So this is one of the biggest structural transition with respect to rural employment. We are moving from Manrega to VBG Ramji. That is Viksit Bharat Guarantee for Rozgar Ajivika Mission, Gramin. This is a topic relevant for your mains also. So, it received an allocation, massive allocation of more than 95,000 crore allocation. So, there are some structural changes. First one is, under the new scheme, more days, more guaranteed days of work. Previously it was 100 days, now it is 125 days. So more guaranteed days of work under the new scheme. Second, cost now will be shared between center and state. Normally 60:40. In special category states, hilly states, it will be 90:10. What was the situation under Manrega? It is a central sponsored. This is also central sponsored. This is central sector. This is also centrally sponsored. This is also centrally sponsored. So what is the difference? Huh? Huh? Either. मनरेगा में 90-10 है. Here wages का 100, materials 75. So there is actually structurally it is centrally sponsored only. Previously also it was centrally sponsored. Now also it is centrally sponsored. Now government said that this is basically a demand driven work. Now government said that it will be more of supply driven. Supply driven. That change is there. Previously material there was a sharing, wage there was sender side contribution. Now wage also there is a clear sharing. States, the biggest reason for this is that there was an issue of ghost beneficiaries. So now states are also having skin in the game. States also knows that okay, I will have to spend 40%. So they will scrutinize it properly. They will make sure that there is no ghost or unintended beneficiaries. So that is the second key aspect with respect to cost. Third one is with respect to work. Work now it will be village, Gram Sabha will identify the requirements and then it will plan the work. Supply side, that is basically the idea. Supply side, it will identify the work. It will identify the work. Who will identify the work? Gram Sabha. ये क्या है? Is it like, can you read this? Yes, where is Rahul? Yeah. You can read this, right? WHK. Previously it was more of a top-down approach. So now it will be more planned by the community. So the community which requires this, they will identify what are the requirements and accordingly it will be planned. And this will also focus more on, the work will also focus more on asset, physical infrastructure, asset building. It will also focus on asset building, long lasting public assets with focus on priority areas will be, the priority areas will be water security, core rural infrastructure like roads, connectivity, core rural, the focus areas, 4 priority areas. First one is water security, second one is core rural infrastructure, roads or things like that. Third one is livelihood related infrastructure. Livelihood related infrastructure like storage, market. And fourth one is climate resilience, climate resilient infrastructure or climate resilience, mitigate extreme weather. These are the 4 important verticals this new initiative will focus. And this will also, it says that the payment will also be faster by using technology, integrating it with technology. Faster payment of wages will be there. Government is proposing a payment within 15 days. Once the job is completed, either it weekly or maximum within 15 days of finishing the work, it will be paid. Another key aspect is there is also a particular period of pause period during harvest season, so that there won't be any problem with respect to labor supply. So to help the agricultural sector, to help the agricultural sector. The scheme will pause for 60 days during peak harvesting season or sowing season. So there won't be any shortage of laborers, workers. Both sowing and harvesting. So these are the key aspects. Because labor shortage is there. Previously it was what? Whatever be the situation, if you demand work, you will have to give work. Completely demand. Whether there is a need or nothing matters. Demand work. And you know that generally there is no major asset building is happening in under Manrega. So Manrega was criticized that you are actually wasting the government's money. Now they are saying, now what problem during the, because of Manrega was that there was a shortage of labor supply. During agricultural seasons, there was a shortage because nobody will go for that, because without much effort they will get money here. Now you are saying that okay, there is a harvest pause. You don't need to give it like work during harvest season because that time job is automatically available. Now a question similar to Manrega, the union government will bear 100% of the wage expenditure under G Ramji 60-40. Under G Ramji Act, VBG Ramji Act, any additional financial expenditure arising from unexpected demand for work will fully absorbed by the central government. It will have to be absorbed by the state government. There is nothing guaranteed by center. Since VBG Ramji has officially replaced Manrega, Union Budget 26-27 completely scrapped the funding of Manrega. It is a transition. It is a transition. So now this year there will be funding for Manrega as well as funding for the new scheme. So it's a transition period. So that is why there is both funding will be there. Now come to another scheme related to employment. That is employment linked incentives. That is PM Viksit Bharat Rozgar Yojana. Viksit Bharat Rozgar Yojana. So this is one of the key aspect of the Yuva Shakti, that is the key agenda of the budget. That is employment generation. But it is not a new scheme, it is a continued version of the employment generation scheme announced in 24-25 budget. It's not a completely new scheme, it is renamed version of the old scheme announced in 24-25 budget. 24-25 budget. And the basic idea is to pay cash incentives to employee and employer. Employee and employer. Means if a new job is created, and what sort of job? That is, formal job. That also means there is a contribution to Provident Fund. Formal job. some social security is there. So if a new formal job is created, then cash incentive will be given to employee. Employee, the cash incentive will be rupees 15,000. But this 15,000 will be split into two stages. First, after completing 6 months, you will get the first payment. Second payment, you will have to complete a digital literacy. You will have to complete a digital literacy program so that you will get the remaining. Employer will get rupees 3,000 per new worker. Employer will get up to 3,000 for every new person they hire. And the financial support at present is proposed to last for 2 years. For most sectors, the financial support will be for 2 years. Most of the sectors, it will be for a period of 2 years. But in manufacturing sector, it will be 4 years. There is also another key criteria that the scheme applies to employees who earn less than 1 lakh. Less than 1 lakh a month. So employer will get the cash incentive only when there is a new job is created. Employer cannot fire one old employee and recruit one new. That's not going to work. There will be a baseline job numbers or figures based on top of it you should create more jobs. Then only it will be available. So that is Prime Minister Viksit Bharat Rozgar Yojana. Next is another key initiative, that is, now there is a question MCQ trap. Under PM Viksit Bharat Rozgar Yojana, youth securing their first employment in state or central government department are provided with a joining bonus of 15,000. What is the mistake? The government idea is not to create jobs in the government sector, but to create jobs in the private sector. PM Viksit Bharat Rozgar Yojana is a UBI, Universal Basic Income, that provides a monthly unemployment allowance. What is the mistake? Next is Pradhan Mantri Awas Yojana. So next one is Pradhan Mantri Awas Yojana. So it's an important government scheme with the aim of housing for all. An important scheme with the aim of housing for all. So this objective is to help the poor people who are homeless or living in temporary houses, kacha houses. That is basically the idea. Now there are two components, PMAY rural and urban, Gramin or rural. Now, so there are two sections. So based on the area where they live, there is PMAY rural and PMAY urban. Now what are the key modus of funding. Grant. Grant is one key mode of funding. Direct cash grant. Whether it is urban or rural, there is a direct cash component. And there was also subsidy on interest subsidy. In the urban component, there was also an interest subsidy on the loans. Initially itself, it was there. But in the rural component, one is a direct grant. Second, they will also get money under Swachh Bharat Abhiyan. Plus, they will also get money for their work. If they help during the construction, then they will also get paid for the manual work. If they are also taking part in the house construction building, then they will also get paid for their work, their contribution, manual labor. Next key aspect is the house has to be registered either in the name of the female head of the family or as a co-owned property or female head. Co-owned property or female head. So this is also an important step towards giving property rights to women, which is an important right, part of women empowerment, giving property rights to women. A very significant step towards women empowerment, towards giving decision making power in the hands of women. So these are the things. PMAY, the nodal ministry is Ministry of Housing and Urban Affairs. In PMAY Rural, it is Ministry of Rural Development. Ministry of Rural Development. Next is inclusion. Sabka Saath, Sabka Vikas. So this is part of the third Kartavya, that is vision of Sabka Saath, Sabka Vikas, inclusive growth. So the first major scheme is Divyangjan Kaushal Yojana. Divyangjan Kaushal Yojana. So this is to help persons with disabilities, Divyangjan, to get good jobs and earn a dignified life. To get some good jobs and earn. Yeah. Rural, social, yeah, SCCC data. No. It is only for SCCC criteria, only for rural areas. So persons with disabilities, they'll get a good job and earn a dignified life. So what are the key aspects? First one, the scheme provides specialized industry relevant skilling. Specialized industry relevant skilling. Industry relevant skilling as per the specific needs of the Divyangjan. So that is basically the key idea, industry relevant skilling. Industry relevant skilling. So this will focus on modern jobs. Modern jobs like IT or animation, visual effects, gaming, AVGC. So these jobs are selected because these are task oriented and process driven. These are task oriented and process driven. So these are based on completing a particular task, whether it is IT, animation, everything. You need to complete a particular task, and it's also process driven. There is a proper step-by-step process. So that is basically needs to be followed. So government is focusing on this thing, and the idea is to ensure that they can adapt to these kind of jobs. Divyangjan, they can adapt to such things. Adaptability. Because task oriented jobs or process driven jobs, if there is some challenges, you can easily adapt to that. Next one is Divyang Sahara Yojana. Divyang Sahara Yojana. So this is a scheme designed to ensure that persons with disabilities as well as senior citizens, this is a catch, not only persons with disabilities plus senior citizens, old age issues, senior citizens, they can get high quality assistive devices, access to high quality assistive devices. High quality assistive devices. It can be artificial limbs or other assistive devices, like including motorized wheelchair or hearing aids, all these assistive aids. Government gives support, under this government gives support to Artificial Limbs Manufacturing Corporation of India. Government gives support to Artificial Limbs Manufacturing Corporation of India, so that they can increase the production of such assistive devices. They can increase the production of assistive devices. This also focus on research and development of high-tech products, AI based products. This will also set up assistive technology marts. Assistive technology marts. Assistive technology marts. So this will serve as a retail outlets, so that you can choose, try and select. You will get more options. You can choose, you can try, and then you can select. Then you can purchase. Under the scheme, it will also expand the present PM Divyasha Kendras. PM Divyasha Kendras. This is also like areas which will provide such assistive devices. Strengthen the PM Divyasha Kendras. That's it. One question. The Divyang Sahara Yojana aimed at providing industry relevant IT and AVGC training to persons with disabilities. What is the problem? It is for Divyang Jan Kaushal Yojana. Divyang Sahara Yojana is basically providing assistive devices, physical assistive devices. The proposed assistive technology marts will function as a retail style centers exclusively for the use of Divyangjans. It is both Divyangjans as well as senior citizens. Next is women. So youth, Divyangjan and women. Women, there is a new scheme, that is She Marts. Government will give support. See, presently government will support this initiative. It will do research, it will come up with more, it's increase the production capacity. Present plan is that only, as per the budget. Yes. Alimco. She Marts, that is self-help entrepreneur marts. These are community owned retail stores. Community owned retail stores. So under SHG, what government did is, government gave loans. Government gave loans so that they can come up with certain income generating opportunities, or generally you can call social business. Now what they need, you are having some kind of business, what they need is, you need an outlet to sell the products. So such an outlet is basically She Marts. It is not completely government created, it will be inbuilt as part of the SHGs or cluster of SHGs. That is basically the idea. It is not government is opening something like a new fair price shop, nothing like that. A ration shop, nothing. But government will promote such outlets to be established within the SHG so that they will get an outlet to sell their product. So they can display and sell their products. So this is properly owned, managed and operated by the community. It is owned, managed and operated by the community. And it will also help to get some innovative funding. Rather than just bank loans, they can go for some innovative funding. It can be some like venture capital, whatever new models of funding, that also can be ensured. Innovative models of funding other than bank loans. This will also help in coming up with the marketing, branding advantages. Like for example, there will be She Mark branding. So special branding, She Mark branding, so that it will be a standout product. Those which like Agromark, like that. So these are the things of She Mart. She Mart initiative is to provide subsidized daily essential to rural and urban women. What is that? Yeah, it is a woman-led enterprises. That is basically the idea. Next is STEM hostels. STEM hostels, these are also called as PM Girls Hostel Scheme. The idea is to build one girls hostel in a district. One girls hostel in a district. And it will be built for women pursuing their higher education in STEM. Pursuing their higher education in STEM. The idea is to solve the long working hours or lab hours or lack of safe facilities, to solve the problems why women may not go to the STEM education is because of the long lab working hours and lack of safe hostel facilities. So if you address this, you can ensure more women coming into the STEM. The funding is government will go for VGF model, viability gap funding. Government will go for viability gap funding model, under which government will provide an initial grant to help private builders or developers. Government will provide a one-time grant to help private developers so that they can construct, they can afford the construction, or it will promote such construction of such hostels. Another key objective is also to improve the overall female labor force participation. Female labor force participation. Because one key aspect with respect to female labor force participation rate is that it is a U-shaped curve. What is the idea? When a country moves from, country GDP increases from agriculture to service sector, initially there will be high participation during the agriculture economy. Then as the country move forward to an industrial economy, it will fall. Then as it enters to service sector based economy, women will re-enter. So in order to re-enter, they should be having highly skilled, especially in STEM. So you give us, because you need to promote the construction of something, so you give an initial grant so that it will incentivize somebody to come up and construct the hostels. Private only, government is not going to construct. Government is only providing a option, yeah. That private? Fee? That nothing is, no details are out how it will be given, because as long as there is a private entity, there will be some kind of charges. The charges depends on what is their intention. If they are just making money, then they will charge more. Next is fiscal policy. So we'll discuss budget related. No, that is also, details are not there. It is just an announced program. Once it is launched, then only we need to see how it will going to be launched, implemented. Yeah? That all I don't know whether question will come or not. So first one is New Income Tax Act. So next area we are going to fiscal policy, taxation. So budget related things also we'll discuss and other areas. First is New Income Tax Act 2025. So it will, the implementation of the New Income Tax Act will come into force from 1st April 2026. It replaces the age-old IT Act 1961. So it is considered as more simplified tax regime. And government says that it is also a paradigm shift from enforcement to facilitation and coercion to trust. Enforcement to facilitation and coercion to trust. It is based on three important principles. First one is overall textual language simplification, textual simplification. So this will help in improving the overall understanding of the law, because otherwise layman cannot understand anything. Second, it will also ensure continuity and certainty. So there is no major policy changes. Thereby, tax laws always needs two things: continuity and certainty. This is very important. Some kind of continuity and certainty, then only it will attract investment, then only it will attract savings, then only it will attract or lead to consumption, everything. So that is another key aspect, ensure continuity and certainty. Third one is no changes with respect to the tax rate, slab. Slab, there is no change. We'll discuss the new slab later. There is no change in the slabs. Now, what are the important changes? First one is the old regime. Old regime, there was a problem of dual terminology. This was very much confusing for ordinary taxpayers. Dual terminology. This dual terminology includes, one is previous year, second one is assessment year. Previous year is the year in which you earned the income, your salary year, whatever. Assessment year is the year after the previous year where the tax is assessed. So if this is previous year is the year 24 or 25, 26 is the period during which you earned the income, your assessment year will be 26, 27. But this dual terminology created lot of confusion for ordinary. They will fill accidentally both, they will fill it accidentally like that. Some mistakes will happen. So because of this, under the new regime, who is talking? You are talking in mobile phone. You. In class. In new regime there will be only one, that is tax year. There will be only tax year. So that is a, so there will be a unified term. So the year in which your tax is taken, that will be considered as the tax year. There is only 1 year, so that will be 25, 26. So that is a year where you earned income, that is also your tax year. There is no previous year and assessment year, there will be only tax year. So that is a key change. So scrapping of the dual terminology. Second, time period for revised return. Statement perspective, you remember, time period for revised return. In the old regime, the time period for revised return was up to December 31st. In the new regime, it will be 31st March. So you will get in exactly 1 year to make any corrections, anything is required, you can do that in the next 1 year. You will get more time. So that is the second key aspect. If there is a mistake, something, you can do that. So you are getting more time to make corrections if there is a mistake. Next is another problem was with respect to, like, if you want to add some income. Now you can update your income up to 4 years. Up to 4 years you can update your income. If you found that, okay, I want to add, you after your mains you sold all your Lakshmikant, you did not mention that in your that year income. Next year you go, like, I sold lot of Lakshmikant. So you can add that and you can update. So it can avoid disputes. That is a advantage. So it will, government is basically giving more time to come clean voluntarily. Voluntarily you come clean. Next key aspect is decriminalization. Decriminalization. So old regime, the maximum punishment was 7 years. No, escape route what? You are actually, you are saying that, okay, I am having this much more income, so you are ready to pay the more income. So it is better to declare voluntarily, no, that is trust. Coercion is what? Income tax will catch, income tax will say this much, then you will pay that. Income tax is having all the data, Project Insight is all there. It can collect the data, it knows what is happening, where is happening, your EWS, everything, income tax knows. 7 years, okay. Previously there was 7 years imprisonment. Sorry, 7 years was the maximum punishment. Now it is reduced to 2 to 3 years. 2 to 3 years. Similarly, the threshold is also like, if there is a evasion up to 10 lakh, then it may not attract jail term. Up to 10 lakh, it may not attract jail term. So 10 lakh and all is considered a small tax evasion now. Okay, so there is no jail term. Another key thing is with respect to tax rates. We discussed that tax rate, there is no change. So what is the new regime's tax rates? How much is the nil, no tax? 1 lakh? 12 lakh? Yes. So up to 4 lakh, no tax. That's it. 4 to 8, 5%. 8 to 12, 10%. 12 to 16, 20%, 15%, right? How much, Aditi? 15%. 16 to 20, 20%. 20 to 24, 25%, and above 24, 30%. No, up to 12 lakhs. So the confusing aspect for statement will be, as per the income tax regime, new rates, slabs, up to 4 lakh there is no tax. But if you are earning something up to 12 lakh, then your income tax liability will be 60,000. If you calculate, you will get that 60,000, and the same 60,000 is given as a tax rebate. So nil tax up to 12 lakh. That is how it is becoming 12 lakh. That is how it is becoming nil. But actual no tax limit is only up to 4 lakh. But the tax rebate of 60,000 is provided now. Now there is a tax rebate of 60,000. And if you are a salaried employee, then a standard deduction of 75,000 is also there. So up to 12 lakh 75,000, you don't need to pay any tax for a salaried employee. This is the tax rate. So this you remember for statement purpose. That's it. Okay. Which second point? See, you filed a tax return. Previously, the time limit was available only up to 31st December. You made some mistakes. Now, even if you made some mistakes, you are getting more time. Another 3 months you are getting extra. So you can fill it up to next year. These are all ITR, Income Tax Act. इस पे और क्या आएगा? No, that is all part of this only. You need to file it. Then it depends on whether you are having a like refund and things like that. That is all different things. So it's part of this only. So this is another. This is very important aspect you should remember with respect to tax rate. 60,000, but there is a tax rebate of 60,000. That is how it is becoming 0 up to 12 lakhs. Next is minimum alternate tax. Let us see some. This also. See, if you are a salaried employee, you will get into service and your salary is up to 12,75,000. You can go for a direct reduction of 75,000 rupees from your salary. Remaining, what will be the salary? 12 lakh. 12 lakh, how much you need to pay? 60,000. So 60,000 tax rebate is there, 60,000 tax rebate is here. So for a salaried employee, this is a standard deduction, a direct deduction from your salary. You can reduce that and this will be your net salary. So eventually that will be same as the normal situation. So let us see some MCQ traps. Under the newly enacted Income Tax Act 2025, the tax slabs remain unchanged, but the assessment year has been legally redefined to mean a period of 2 years to give taxpayers more time. Now there is only tax year. Some other questions we'll see. The newly enacted income tax act 2025 increased the baseline income tax rates to boost government revenues. The idea is basically to boost consumption. Next is MAT overhaul, minimum alternate tax. So this particular tax is also completely redesigned. So for a business, what is the normal tax? Normal tax is corporate tax. Presently the corporate tax rate is around 22 plus cess and also 25%, 22% plus. So 25% is the corporate tax now. But some companies, you know this, right? Some companies, they may not pay corporate tax or they may not pay income tax. They may not pay income tax or they pay very minimal income tax. Why? Or they are also called as zero tax companies. Why? Yeah, they use various exemption deductions and all. So they pay either zero tax or very low tax. So this is a loss for the government. This model is a loss for the government. Why it is a loss? Because these same companies pay dividend to their shareholders based on their book profit. What is this? What is the reason for this difference? Very good. This is calculated based on P&L, Companies Act. This is calculated based on Income Tax Act. So there is two different acts used here. So P&L is calculated based on the Companies Act. So they will show profit and they will pay dividend to the shareholders. But here they will show low tax or they may not show tax or they may not pay tax at all. So what happens in this situation? Previous regime, the old MAT regime, the past regime, a minimum normal tax is corporate tax. So an alternate tax has to be charged from these companies. So that was a fixed rate of 15%. So if a company, if it is showing a book profit of 100 crore, then it has to pay a MAT of 15 crore. So this is whatever be the highest. So generally what happens, they won't pay corporate tax. They may say, for example, corporate tax only, just for the example purpose, only 1 crore. So in this case, companies has to pay which tax? MAT. So companies paid MAT 15 crore, but their calculated corporate tax is only 1 crore. So there is something called as MAT credit. So the balance 14 crore will be MAT credit for the company. So this will go to the company's credit. Company can use it later. So next year if the CT is say for example 10 crore, it is already having a balance of 14 crore. So it can use that credit to pay the corporate tax. This MAT credit was a good option for the companies. Now government said that, government brought some major changes. One is government, what is the objective of the government? Objective of the government is that companies has to shift to the normal tax regime. Normal tax regime. Thereby companies will pay how much? Yeah, 20 or 22 or 25 percentage tax. So this is a nudging. By the government to shift the companies from the MAT regime to new regime. So what are the changes government is bringing? First one is the overall MAT, old regime and new regime. Old regime, what was the MAT? 15%. Government reduced that to 14%, 1% reduction. That is the first thing. Second, previously there was a MAT credit. Now government said that this will be your final liability. Means if you are coming under the 14%, if you pay that 14%, for example 14 crore as your tax, that is gone. You pay 14 crore, it's gone. No more, yeah, carry forward, no more credit system. That is a final liability. So you pay that, it is gone. Or you pay the corporate tax, that's it. So this is the second key aspect. Reduced it, but government said that this will be the final tax liability. Another key aspect is that if they are still sticking to the old regime, companies want to stick to the old regime, then what is their option? They will have to pay this and gone. They are not going to get any MAT credit. Their all MAT credit, whatever they accumulated, will be exhausted. So every year you pay 14% and over. But if those want to shift to the new regime, so you need to incentivize those things, those companies. So to incentivize those companies which are ready to shift to the concession new regime, they can use their MAT credit up to 25% in a financial year. Up to 25% in a financial year. And they should use this within a 15-year period, carry forward period. So this is a very significant redesign. Why they will? No, that is government's rule. Whichever is higher, you pay that. Their actual liability, they are intentionally reducing it low. They are not using all the deductions. They are saying that my corporate tax liability is only 1 crore. But they are paying a huge dividend to their shareholders. So they are increasing their business value. But they are not paying tax. Now government said that when CT is 1 CR and MAT is, say for example 2 CR, whichever is higher you pay that to me. Because I am giving an alternate tax, or I am putting an alternate tax on such companies. Why? Because these companies are zero tax companies. So they are intentionally not paying corporate tax. So that is why I am putting an alternate tax. No, they can use it. So they will use it or lose it. So they will use it. So gradually they will use it. So now government is saying that that was the system before. So government knows that this is not a perfect system. So government said that now there is nothing. Now this is your final liability. You pay this and that is it. There is no MAT credit. New MAT credits are not given. It's old, accumulated one. You can use it only if you are shifting to new regime. That is a cap. What is a cap? 25%. There is no new MAT credit. There is no carry forward now. It is the final liability. That's it. Jaldi jaldi पूछो हाँ. Entire. You use it and you finish that in a specific period, 15-year period. Huh. No, then you will have to pay that tax. Then there is no MAT. If you are paying CT, then that is your liability. You pay that. See, minimum alternate tax is only applicable when your income tax is 0. So you are not paying anything. Then only I am putting an alternate tax to take some money from these companies. I want to get some money from these companies. How I can? I am putting an alternate tax. Because I am not able to collect money from these companies because they are showing their income tax as 0. The moment I am showing income tax, then I am not coming under this alternate tax. Then I will pay the income tax as per the whatever be the rate, 20%, 25%, 30%, whatever be the rate. Now, presently it is 22% plus. So it is coming around 25%. So that will be my liability. No, that is only 15%. No, that is when you are paying, you will use the credit only you to pay the normal tax. Huh. Anything can happen here. छोड़ दो ऐसा No, you are setting off. You are having companies or what? Which is not paying tax. हाँ जल्दी पूछो. हाँ तो आपका पूरा खत्म हो गया. हाँ वही है शेयर बाई बैक. आपको कुछ क्रेडिट ही नहीं है. हाँ लैप्स हो गया. नहीं. You can still next year you can pay 14%. आपको कुछ बेनिफिट नहीं मिलने वाला. इसी साल. No, see, if you are sticking to the old, then you don't enjoy any benefit. If you are moving, then you can use 25%. No, you can use it gradually. I can finish it in the period of 15 years. हाँ जाओ आपकी मर्जी. No problem. Next is one question. To boost corporate tax collections and prevent tax evasion, budget 26-27 increase the minimum alternate tax rate to 18%. What is the answer? Reduce to 14%. Next is share buyback. What is the idea of share buyback? Yeah, what is the basic idea? Consolidation, but what is the basic idea? Increase the valuation. Oh, babre. Owners are giving shares. So, repurchase of their own shares. That's it. Repurchase of their own shares is basically share buyback. So when a company buys back its own shares or repurchase its own shares from the shareholders, existing shareholders, that is buyback. Now what is the new rule? So there was a there is a background also to this. So from 2024 onwards, so what generally happens is that when you buy share, you bought share, say for example at 100 rupees, 10 lot. So how much is your overall? Oh, very good. You bought for 1000 rupees. Now in the previous system, what was the problem? Now when you are selling it, that is through buyback, say for example there is a premium. So it is bought for a share at 200 price, same lot, 10 shares a lot. Then what is your share price? Very good, 2000. So from 2024 onwards, your tax will be calculated on this full amount. Full amount. Actually, what is your gain? Your gain is only 1000, not crore, 1000 rupees. Only 1000 rupees. So you should pay a capital gain of whatever amount only on this 1000 rupees. But from 2024 onwards, you will have to pay tax on the net sold amount. So that means you will be paying higher tax. So that is changed now. What is a major change? Now government from this budget 26-27 onwards, share buyback will be taxed on capital gains. That is on capital gains. So how much will be the tax on? 1000 rupees only you will have to pay. Share buyback will be taxed on the capital gains. What? Yeah, it will be deducted. So that will be the final amount. Okay, so that is a change. And there is also one more aspect. Promoters will have to pay an extra tax. Promoters will have to pay an extra tax. So promoters who enjoy in the share buyback, they will have to pay an extra tax, so that there is no manipulation, or to prevent any gaming of the system, they will have to pay extra amount. For individuals and those who are not promoters, then they will have to pay as per the long-term capital gains tax and short-term capital gains tax amount, 12.5% and 20%. You need to pay capital gains tax of 12.5% and STCG of 20%. Okay. So these are the things. One question: under the changed provisions, the proceeds from share buybacks will be taxed at a uniform flat rate of 12.5% for all classes of shareholders. It is 12.5 for LTCG and 20% for short term, and for promoters it is higher than that. There is an extra tax. Next is GST. Now we are coming to other areas. First one is GST. Who will be part of that company's board of directors. Who is basically what are the criteria to consider as a promoter? Yeah, contribution to the paid up capital and all those things. Next is GST 2.0. How much capital, basically how much share you are holding? Their value will increase because the number of shares now decreased in the market, so automatically their value will increase. So previously there was 1000 shares, now there is only 500 shares. GST 2.0. So GST is introduced by which Amendment Act? 101. Which year? 2017. 2017 GST was introduced. Now the key features everybody knows, it is a destination based tax, consumption tax. It is essentially a value added tax, and it operates via which models? There is a CGST and there is a SGST. That is for intra-state transfers. Interstate transfers, there is a IGST. So these are the key typical things of GST, and there is also a GST Council, which is a constitutional body, which is the decision making body of GST, and we already discussed the decision making model, voting pattern and all. Voting pattern, pooled sovereignty idea. What is a voting pattern? Okay. Then there is also GSTAT, that is the tribunal, appellate tribunal. So that also we covered in our polity. There is also one more implementation wing, that is Director General of GST Intelligence. Director General of GST Intelligence. It is a primary enforcement body. Primary enforcement body. So these are the general things. What is the key aspects of GST? It reduced cascading effects, subsumed many indirect taxes, all those things. Now come to GST 2.0. From September 2025 onwards, there are some structural changes with respect to the GST. So first one is the tax rate rationalization. So there are now majorly two rates, that is, one is 5% and another one is 18%. So these are for merit goods, and there is also one more key aspect is that there is a special rate. So this is standard rate 18%, this is for merit goods, and then there is a special rate. The special rate is 40%. So previously there was multiple slabs, 5%, 12%. Major slabs were 5%, 12%, 18% and 28%, plus there are slabs for say gold, diamond, like that there was separate slabs also. That is maintained. Those slabs for gold, diamond, etc. is maintained, 3% and all, 1.5 and 3% that maintained. But these multiple slabs were subsumed. For example, these two will come here. Majority of this will come here, and a majority of this will also come here. Plus there is a special rate for luxury and sin goods. Plus there is a special rate for luxury and sin goods. So these are basically a demerit rate. Demerit rate. This covers aerated drinks, large SUVs, aerated drinks, SUVs, online gaming. So all your area will come under 40%. Okay. So that is the first thing, rate rationalization. Please do remember these important things. First one is 5% merit rate, that is for daily use items, agricultural inputs. UPSC is asking such questions also. So you need to know that. Second is 18%, that is the primary revenue source. So major consumer durables, white goods, this will come under the 18%. So they reduce from 28 to 18%, especially the major white goods. Mobile phones and all is which rate? Standard rate 18%. Previously also mobile phone was an 18%. It is kept under the same 18%. Then there is a 40% demerit rate. Then there is a special rates which are retained. Retained means the previous rates are retained. Next is end of GST compensation. GST compensation. So GST compensation was introduced and charged on top of the which rate? GST compensation was charged on top of which rate? 40? 28%. The highest slab in the previous regime. 28%. And that was charged on 28% on the demerit goods, luxury goods, sin goods. And what was the objective of this? To compensate the revenue loss for states. That was the original idea. And finally it is abolished, completely abolished now, GST compensation cess. And from 2026 onwards, there is a cess on sin goods. Cess on sin goods like pan masala and all. So this will be called as specific health and national security cess. So because of the abolition of the sin goods, now there is a cess for pan masala, it will be reintroduced under specific health and national security cess. So that is the idea. So pan masala will be charged under the demerit, so 40%, plus there will be a cess, I think it is coming around 48% or something. So something around 88% will be the total tax on pan masala and all. Again, your areas are all very costly. It's becoming very costly. There is a very interesting video. Whenever pan masala, I am thinking of, like, whenever I read pan masala, I used to tell in class also. There is a video of like villagers will be sitting. So one pradhan or somebody will be talking. So one person who was sitting in part of the group, he is doing this thing. So since he was speaking something, all others will Start clapping. Thinking that somebody clapped for it. So for us, there is only one clap, that is for India, this only. So health, and this is now very high tax, 40% plus 48% around. So that is how it is compensated. By taking out from the GST compensation, it is now put under a new cess. Similarly, Central Excise Amendment Act. Central Excise Amendment Act. It was amended 2025, Central Excise Amendment Act, and reintroduced excise duty on tobacco. Excise duty on tobacco. So the cess is replaced with a excise duty on tobacco. Now what is the difference between pan masala and cigarette? This is replaced, no, difference not in the way of consumption. With respect to the tax, for you sir, both I think cigarette is giving this, nasha, no, that is not the question. So what is the basic difference? It is under a cess. So this will go entirely to, yeah, center. This is excise duty. So this will go to the divisible pool. So there is a lot of criticism with respect to the use of cess and surcharge as a means by the center, thereby reducing the overall divisible pool. Divisible pool. So that is the 16th Finance Commission recommended a grand bargain. Grand bargain. It said there should be a grand bargain. What is a grand bargain? State means you add more to the divisible pool. Sender should add more to the divisible pool. On one side, sender add more to the divisible pool. Other side, state will be ready to get a lesser percentage of the divisible pool. Presently it is 41%. Now if state is insisting that we need 41%, then this bargain may not work. So states should reduce their overall demand from the divisible pool. Maybe you can take it lesser than 41%, but sender add more to the divisible pool. Now UPSC this year, this will be the first year, if at all if there is a question comes, question can be grand bargain in news related to which of the following, something like that also can come as a question, because it was also in news related to 16th Finance Commission. Okay. So tax. So this will be another key aspect, how this taking out the compensation cess will lead to changes with respect to the sin goods like pan masala and cigarettes. So that is, next one is anti-profiteering. Before that, let us discuss that inverted duty structure. Huh? No, it's not excluded. There is an excise duty charged on it. No, GST is on pan masala also. 40%. 40% plus cess of 48%. So total 88% is coming. There also it will increase. Now it will be charged based on the number of sticks or something, length of the cigarette, number of sticks, and all this will be calculated. That is all, you don't need to know. You just leave it. You should know that it is increasing, it's costly, it's not good for health if at all anybody is consuming. Next is inverted duty structure. So there is a anomaly. What is anomaly with respect to the duty tax structure? Yeah, tax on the raw materials is higher than the tax on the finished goods or output. This is the problem. So GST also corrects such anomalies in sectors like textiles, fertilizers, coal sector. These are the areas where it is textiles, coal, fertilizer. So GST corrects such anomalies by increasing the tax. Okay. Next is anti-profiteering. Now, what is the problem with respect to this inverted duty structure from the tax point of view? Yeah, it will lead to accumulation of input tax credit. Because the final product is tax less, always lead to an accumulation of ITC. That is the biggest challenge. Next is anti-profiteering. So anti-profiteering was introduced so that business will pass on the benefits of reduced tax rates to the final consumers. Business should pass on the reduced tax rate to the final consumers by reducing the overall price. So originally when it was introduced, anti-profiteering clause was introduced, but it was originally with a sunset clause. So in the initial years, in order to look into the anti-profiteering matters, there was also an entity that was National Anti-Profiteering Authority. National Anti-Profiteering Authority. But with the sunset clause, it is ended. That authority also ceased to exist. Now the matters of anti-profiteering will be taken up by Central Consumer Protection Authority. Central Consumer Protection Authority as well as the tribunal, that is GSTAT. GSTAT. So they will investigate such a unfair trade practices. Next is STT, Securities Transaction Tax. Let us see some questions. State legislatures are empowered to alter the SGST rates for goods produced within their respective borders. Yeah, only GST Council can make any changes with respect to these kind of things. Next is, thank you. The highest 28% slab was entirely abolished under GST 2.0, leaving 18% as the maximum and introducing a 40% slab. And introducing a 40% slab required a constitutional amendment. Highest slab is now 40%. It does not require any changes with respect to the constitutional amendment. So already the CGST Act permits a maximum statutory slab of 40%. But if you want to increase more than 40%, then you will have to bring changes. No. I understood. Mohit Minerals case also. What was the case about? This we discussed. It is not bound. But what is the actual status? If there is a law which says that this has to be followed, then you have to follow that. Getting it? Presently, the law of the land will be based on Mohit Minerals, but that is based on the general case. But if a law says, CGST says, Central GST law says that this has to be done like this. This is the way decision making is done. So something is established. Then that is the law of the land. So next is securities. There is one more. Central Consumer Protection Authority. Previously it was under CCI. Now it is under Central Consumer Protection Authority. Now one more question is there. Chance is very less. Cigarette is under 28% slab. BD is under 18% slab. 28 plus this excise duty and all. Okay. That is pan masala. ये सब अलग अलग है यार. No. Now there will be tobacco plus. Now it will be 40%. Sorry. Now it will be also 40%. Yeah. But BD is on the 18%. You don't know the difference. Okay. See, one is the final products rate increased. For example, if previously it was 5%, you make it 18%. Another one is you give back the ITC within a specific period of time. For example, 90 days you finish the whatever is accumulated, you give it back. These are the. Yeah, it will be given back because you are accumulated that because of this thing. So you will get that money back, though the final product is not rated high. 5% is the fabric rate, but you bought something for 18%. So there is an anomaly. What you can do, you increase it to 18%, so there is no anomaly. You will get automatically ITC. So you can set off. If that is not happening, there is a system whereby you file it and you will get the money. You return, you will get that return. GST under GST 2.0, all health and life insurance premium, including corporate group policies, are completely exempt from GST. What is the correct answer? Yeah, corporate is still having the commercial nature, so it is not excluded. Individual health and life insurance policies are now 0 rated, exempted, nil rated. One more question. To discourage the use of fossil fuels and promote green energy, the GST Council increased the tax on coal from 5% to 18%. Wrong है तो answer क्या है? What is the answer? To discourage the use of fossil fuels and promote green energy, GST Council increased the tax on coal from 5% to 18%. See, the idea is basically what? Yeah, it is having a inverted duty structure problem. So it is not to discourage. It is basically to correct the anomaly of inverted duty structure. Its price also increased to 18%. That is the reason that change is brought, not to bring any green tax, but basically to correct the anomaly of inverted duty structure. It's not called penalty. Okay, next is come to STT, Securities Transaction Tax. So when you buy or sell securities, so generally there are two taxes. What are the two taxes? Yeah, one is capital gains tax, another one is security transaction tax. So these are the two taxes that deals with the buying and selling of securities. अरे ये क्यों पूछ रहा तेजस्वी? क्या ऑपोजिट हो रहा है? पहले previously it was 18% and it was 5%, plus there was a compensation cess. That is how it was managed. Now that compensation cess is gone, so automatically the output will be costing 5%. So government said that okay, you increase that to 18%. The reason is not because of increase it as a green tax. The reason is basically to prevent this anomaly, you increase the output tax. The idea is not with respect to any other reason. The compensation cess was reduced, so now the cost will be low, so you increase it. So security, so when you invest in the stock market, so the government collects revenue two ways. One is CGT, another one is STT. Both are direct tax. Both are direct tax. So how you will pay? You will pay your price based on what? Selling price minus buying, acquisition, whatever buying price, for simple understanding. Buying price, the gain is what? This is the gain. So you pay tax on it. Whatever be the gain, if it is short term, that is less than 1 year, 12 months, then 12.5. If it is long term, then it is, short term it is 20%, long term it is 12.5. So you will calculate and pay it only on the gain. Now, so CGT you will pay only when there is a gain. But STT you will pay whenever you buy or sell securities or whenever you trade. So you bought, that time also you paid STT, you sold, that time also you paid STT. This will happen automatically at the exchange level. Exchange itself will cut and it will take the money, kind of a TDS mechanism, tax collected, TCS mechanism, tax collected at source, TCS mechanism. So it will basically collected by the exchange, maybe it will be 0.01% or whatever. It will be very minute amount, but it will be on the overall amount of that particular lot. Whatever be the total amount you bought, whatever be the total amount you sold. Here it will be only on the gain. Here you got some profit, so you are paying it. Here whether you got profit or loss, it doesn't matter. If you are trading, you will have to pay the securities transaction tax. So it is basically whenever you enter or exit, you will have to pay. That is why it is sometimes called as, it is similar to toll gate tax. Toll gate tax. You enter, you pay, you exit, you pay, whatever. So that is the key aspect, and it is on the value of the transaction. It is on the value of the transaction. So whether you made profit or not, it doesn't matter. You will have to pay based on the value of the transaction. Now it was in news because government increased the STT on futures and options. Futures and options, derivatives. What is the general idea of futures and options? Yeah, for a, you will basically will have an agreement over a future date. In future, what is the basic idea? It is mandatory. You agreed to buy something at a particular price on a predetermined date, then you will have to buy it. Option, as the option says, you can pay a premium. You can pay a premium and you can book, like the now I think in tickets are also like that. You can block the ticket by paying some amount. If you are not continuing with that booking, then you lose that particular amount you paid. Means here you are an option to exit also. So that is basically, so what is happening, just for understanding purpose, you should know that in stock market this is kind of a complete speculation, very high speculation. Very high speculation. So lot of people, ordinary citizens, are losing money. Because they'll speculate, they lose money. So government want to discourage this. So to discourage this, government increase the STT on futures and options. To discourage this, government increase the STT on futures and options. Okay, so that is the STT aspects. Next, come to some exchange will collect amount. That is why it will be collected only if the whatever like you are doing in a proper exchange. STT will be listed in the exchange. What is you are doing in exchange only, there will be STTs collect. For your broker will collect, that's it. So STT is an indirect tax levied on brokers for facilitating transactions on stock exchange. Yeah, it is levied at the time of purchase as well as sale. STT is applicable to the transfers of all shares, including unlisted shares. It is listed on the recognized stock exchange. There was a massive 150% hike in STT on futures and options. It was implemented to offset the fiscal deficit and maximize tax revenues. What is the answer? To prevent the speculative activity. STT works on the principle of tax deducted at source. It is worked on the principle of tax collected at source. In short-term capital gains on all classes of financial assets are uniformly taxed at a flat rate of 20%. So there is a catch here also. In the case of those things where you paid STCG, then 20% will be applicable. If it did not pay STCG, then higher tax will be applicable. In those securities where you paid STCG, then 20% will be applicable in the short term. If you did not pay STCG, then higher tax will be applicable. Next is taxation on virtual assets. virtual digital assets. So under the Income Tax Act 2025, it explicitly included virtual digital assets in the definition of property. VDA is now included in the definition of property. So that means it will be counted as a capital asset. It will be counted as a capital asset. So it will be similar to land or jewelry, gold, bullion, same category, and it is a tradable asset. So since it is a tradable asset, it is like a property. The income earned from this trade will be coming under capital gains tax. And what is the CGT for virtual digital assets? 30%, 30. Similarly, from 1st April 2026, the crypto exchanges, various crypto exchanges are there. The crypto exchanges are legally mandated to report your transaction to IT department. Legally mandated to report your transaction to IT department. From 1st April 2026, the crypto exchanges are legally mandated to report the transaction data to IT department, and if it fails, then there will be fine for the exchanges. But the key point to be remembered here is that India has not legalized. There is no legalization, legal validity for Bitcoin, crypto. So there is no legal validity. And also they are not having any legal stance under SEBI. It is also not regulated by SEBI. So trading is not happening through the stock exchange. It is through the outside crypto exchanges. So it is not regulated by SEBI. So since it is not regulated by SEBI, there is no investor protection available to this cryptos. No investor protection. Tax is there, but nothing. It is basically to discourage it. The tax, very high tax is charged to discourage. Similarly, there is no loss set off. So when you bought Bitcoin for a particular price, but you sold Ethereum for a loss. Originally, if it in the other properties case, you can set off. But such a set off is not available here. If you made some gain on the selling of, say for example, you made a gain of selling of Bitcoin, say for example, 1,10,000 rupees. Then you pay 30%, 3,000 for that. That's it. Now you lost, say for example, 5,000 when you sold Ethereum. But generally what you can set off it. This set off is not available here because it is basically to discourage. So gain you will have to like pay the tax, loss it won't get set off. So that is, and also there is also a 1% TDS. 1% TDS on all transaction of VDA. Eh? Eh? What? No, TDS. What? Yeah, deducted at source. No, it is a different mechanism. TCS and TDS is different. Next is there is also strict KYC. Strict KYC. For example, they will use penny drop method. They will use live selfie penny drop method. What is a penny drop method? Yeah, 1 rupee will be deducted from your bank account. That is penny drop. A nominal 1 rupee will be deducted for verification. So that it will just check, okay, there is an account is in this name, and 1 rupee will go. Sometimes you might have, when you are doing something, you might have come across those things, right? Next is the definition of undisclosed income. The definition of undisclosed income is also now includes VDA under the IT Act. Next, there are campaigns against such a tax evasion. One is Project Insight. Project Insight. So it's a data mining by CBDT, Central Board of Direct Taxes, data mining initiative. There is also another one launched by CBDT, that is Nudge. Nudge, that is non-intrusive usage of data. Non-intrusive usage of data to guide and enable. So they will send notices to those people who are trading with the VDA but not disclosing their income. Now there are some global practices. One is OECD's CARF, Crypto Asset Reporting Framework. OECD's Crypto Asset Reporting Framework. India decided to adopt this framework, Crypto Asset Reporting Framework. And planning to operationalize by 2027. So under this there will be automatic sharing of data between the countries. So automatic exchange of information. Presently US is not a part of CARF. We will discuss after class. Next is, another one is double taxation avoidance agreement. So this is recently news because of a case that is generally called as Tiger Global case. What is the matter about? What is the matter? Tiger Global case. Recently also it was in news. You guessed it correct. Double taxation avoidance agreement. Tax avoidance. So this is related to Flipkart Walmart deal. So Tiger Global, which held shares of Flipkart, sold its shares to Walmart by routing through Mauritius and thereby avoiding tax. So Supreme Court said that Tiger Global must pay the taxes for this because it was completely related to an Indian entity transaction. So the court ruled against the Tiger Global's argument that we are having a residency certificate of Mauritius. So what is basically the idea of double taxation? What is double taxation issue? Yeah, it is when a business pays tax on the same income in two different countries, two different tax jurisdictions, same income. So to prevent such things, double taxation avoidance agreement is introduced. Not only that, this will also facilitate the flow of capital investment. This will also facilitate the flow of capital and investment. So this is basically a treaty in good faith. Good faith to facilitate the investment, facilitate the trade, and also business, if they are paying two tax for the same income, that has to be prevented or that has to be addressed. So double taxation avoidance agreement is signed by India with many countries including Mauritius. Recently it was in news, DTA also was in news because we made some changes with our France, Belgium and all. So this was also another context. So what is happening? There is something called as treaty shopping. What is treaty shopping? You might have studied these things. Treaty shopping. What is treaty shopping? Yeah, it is basically a third party from another country with which India does not have a treaty of tax avoidance treaty, trying to use the treaty to avoid tax. That is treaty shopping. They are shopping in Mauritius. Why they are shopping in Mauritius? Only because India and Mauritius enjoys a tax avoidance treaty agreement. That is basically the idea. So for this, to prevent this is basically what? It is tax avoidance. Tax avoidance. So it is important to prevent tax avoidance. So there are certain things like limitation of benefit clause. What is limitation of benefit clause? No, the benefit of the treaty will be available only if there is certain conditions are met. The benefit of the treaty will be treaty. This is double taxation avoidance treaty. That benefit of the treaty will be available only if there is certain conditions met. What are the conditions? They has to be originally from that particular country. They are originally residents of their country. There is an original business. That is the idea. So court will check, for example, or globally, what is the test? Principal purpose test. Principal purpose test. So courts will see whether the principal purpose of establishing a company, shell company or mailbox company is to avoid tax. Because what generally they will do? This country will set up a mailbox company or a shell company in Mauritius. For example, India and US is not having treaty. So USA company will set up a shell company in Mauritius and will do business with India. So under the principal purposes, they will see the principal purpose of this company established is to avoid the tax. If that is the case, then the tax benefits will be denied. Similarly, there is one more term, that is place of effective management. Same idea only, place of effective management. What is place of effective management? Yeah, actual decision making management is sitting in which country? Actual decision making or the management is sitting in which country? Next is equalization levy. I hope everybody knows this. Is there any discussion required? Then you tell. What is the basic idea of equalization levy? Yeah, it was few things it was introduced in. Fast we'll do. Introduced in 2016. This was also called as Google tax or Google Facebook tax, whatever. So 6% on online advertisement in non-resident companies. That was the original equalization levy. Second, it was expanded in 2020. A 2% levy on e-commerce of non-resident companies was also charged. But last year, April 2025, equalization levy was abolished. One of the major reasons for the abolition of equalization levy was it was criticized as a digital tax by USA and all. They said that this is basically affects the interest of US companies in India. So this was also considered as a reason for the trade war, digital tax. So it was completely abolished. Now how it is charged? Since it is abolished as a separate mechanism, it is abolished. So now India continues to tax the foreign digital firms under a rule, that is significant economic presence rule. Significant economic presence rule. So a taxable presence is triggered. A significant economic presence, that is taxable presence. Taxable presence is triggered once an entity crosses rupees 2 crore in transactions rupees 2 crore in transactions and has at least 3 lakh users, local users. No, both are required. Then only the 2 crore will come. कुछ लोग चाहिए इधर नेटफ्लिक्स देख रहा है पूरा दिन. Next is BEPS. So continuation of this only, base erosion and profit shifting. This, to address BEPS only we introduced equalization levy. Companies are shifting their profit leading to the tax base erosion. Tax base erosion. So OECD countries come up with a solution. These are called as 2-pillar solution. Two-pillar solution. The first pillar, pillar 1 is taxing the digital economy. That is taxing the digital business. Taxing the digital business, that is making money without physical presence. That is the first pillar. So under this pillar 1, it reallocates taxing rights to the market countries. This will be useful in your mains also. It reallocates the taxing rights to market countries where the market exists. Market countries. Second pillar, pillar 2. Pillar 2 is about global minimum corporate tax. So pillar 1, equalization levy is an example of pillar 1. Pillar 2 is global minimum tax, which mandates a minimum corporate tax of 15%, 1.5. Presently, that is what is the negotiations going on. Global minimum corporate tax of 15%. It operates by way of a domestic top-up tax. UAE introduced this domestic top-up tax. What is the idea? If a company, here what is the, here there is no presence. Here what happens, company will have a presence in the tax heaven. So they won't pay any tax. So in that case, you can, either you can charge a 15% domestic, or they will have to charge at least 15%. So this incentive to shift to tax haven will be lost. Next is whatever we already discussed, so that is just summarized and given. There is a new fiscal anchor. Last class we discussed this. Fiscal anchor will be what? Debt to GDP ratio. And it will be a glide path. What is a glide path? 50% plus or minus 1%. What is the target year? 2030, 31. Yeah. Presently the center's debt, only central government debt is 55.6%. And debt sustainability depends on whether the interest rate, your nominal GDP rate, growth rate is higher than the rate of interest. There is also some other aspects of this, how the government is planning to implement it. One is by active bond switching. What is the idea? Active bond switching. Yeah, governments, many of the, see, government will have short term and long term bonds. So when a short term bond, government's biggest problem will be short term bonds. If the short term bonds are getting matured, government want to switch that with a long term bond. So government will give an option for the investor, okay, you can switch to the long term, and thereby government burden of repayment will reduce. That is active bond switching. You switch the bond from a short term to longer term. That is the idea. Then there is also plan to establish a PDMA, that is Public Debt Management Authority. Presently our debt is managed by RBI. RBI is managing the government's public debt. There is a public debt office under RBI, PDO. What are the benefits of the debt to GDP as an anchor compared to fiscal deficit? Yeah, more space, especially counter-cyclical policies. What is a counter-cyclical policy? When there is a slowdown, government should pump more money, government should have the option to pump more money. If there is a strict fiscal deficit target, then that government's option to pump more money will be, or stimulus will be less. This was a problem for India during the past. Second key aspect is that this is also recommended by FRBM review committee, encasing. But he said the debt to GDP ratio has to be 60%, 40 plus 20, total general government debt, 40% center and 20% state. So this was also suggestion by FRBM review committee encasing. And this will give a better picture of the country's fiscal situation, status. That is why the moment we announced that we are going to shift towards debt to GDP ratio, S&P, Standard & Poor, increased our rating, credit rating. So this will also lead to better credit rating. And another key thing is that we introduced FRBM. At the center level, we introduced FRBM in 2003. See, rain and all is not a reason for not coming to the class. Or I think PMTs are over now. So, okay, PMTs are over now, no need to come. PMT is an additional thing. Study, utilize your time. See, there will be students who will be studying like from online also very properly, very genuinely. But I am talking about those students who are coming offline. Suddenly you are shifting to online, then coming back to offline. Those who are in online, they will do very systematically because they are having a plan to do it. Those who are doing offline, you also should have a plan that okay, I will do my thing systematically. So students who are doing online systematically, they are also getting very good score. They are clearing with very good rank. But the problem for offline will be you are very much like based on your convenience, you are shifting the mode. At least online students are having a clarity. Okay, this is how I want to do it, and they are having a plan. They'll implement it. So your case, what you need to do is, you should ensure that whether rain or summer, winter, doesn't matter. You will have to come to class. You will have to finish it. You will have to revise it. Okay, so what we are discussing? So this is also like we at the central level, there are FRLs at the state level, fiscal responsibility legislations. So at the central level, FRBM introduced 2003. There was only 1 year where we could meet the fiscal deficit target of 3%. So historically, we could never achieve the strict set target of 3% of fiscal deficit under FRBM. So historically, it was not working. We could never achieve that 3% fiscal deficit unless other than 1 year. I think that is in 2007-8 or something. Only 1 year. 1 year, that also. Okay, that's it. So next is RBI surplus. This is last year question. So possibility is bit less. So RBI's surplus. So RBI's transfer to the government is not called as dividend. Why? Yeah, RBI is not a profit making entity. So like PSUs are a profit making entity. So PSUs transfer to the government is called as dividend. RBI is not established with an intention to be a profit making entity. So its transfer is called as surplus transfer. But RBI makes money, that is called as incidental income. RBI makes money which is basically called as incidental income. As part of its working function, it makes some money. So when RBI performs its functions, it makes some money. So the key aspects of RBI is asset and liabilities. Assets and liabilities. On the asset side, what are the key things? Foreign currency assets. Foreign currency assets. Then there is gold. Then there is government securities. Government securities, for which it will earn interest. And then loans given to governments, state government or central government, who are loans given. These are the asset. Liabilities, the paid up capital. Second, currency with the public. That is a liability of the central bank. Currency with the public. Third one is deposits from banks or governments. Deposits from banks or governments. Then the reserves. Reserves kept by RBI. What are the reserves? Yeah, there will be a contingency reserve, contingency fund. There will also be currency and gold revaluation account. Currency and gold revaluation account. Currency and gold revaluation account, because it will fluctuate. Forex and gold will fluctuate, so you need to keep a revaluation account. Now my question is, So this is asset and liabilities from where RBI earns income. From which all RBI earns income? One is income from foreign currency assets, that's an income. It can be currency, it can be securities, whatever. Then government securities, interest earned from the government securities, there is also income. Loans given, you will get interest on that. But RBI's liabilities are mainly, what are the liabilities? Currency in circulation. Rest are very like not a major liabilities, currency in circulation. So the liability for RBI, the liability is comparatively lower than the overall income. From this comes surplus. There is also one more term, that is seigniorage income. What is seigniorage? Printing of the currency. See, currency for RBI, actually there is a problem with respect to understanding of seigniorage. That is why I am asking. Most of the people who don't know what I felt in the previous class also. So what is the basic idea of seigniorage income? See, currency for RBI is a low liability aspect. Only what is the cost? Cost of printing. So what happens is that when currency is printed, how it will be distributed? Government securities. Government will give some bond and RBI will inject money. The interest earned on that bond is basically the seigniorage income. That is seigniorage income. Not just the printing currency is expenditure is only 5 rupees. So RBI is releasing 500. So 495 is the income. That is basically rough calculation only. What generally happens is that RBI prints a currency, then RBI has to circulate it. How RBI will circulate it? Government will give some bonds. So bonds will go, money will come out. So when bonds go, bonds will have some, that is why it is earned income. Seigniorage is an earned income. So because of the bond, that difference is basically the seigniorage income. That is also an income for the RBI. So as per the economic capital framework, RBI has to keep some reserves and balance amount RBI has to transfer to the government. So the contingency reserve RBI will keep so that any problem it can manage. Remaining amount it will transfer. So if there is a more income from the foreign currency reserves or the bonds, then and the surplus will also be high. So this is from budget perspective, it is under which category? Okay. So these are the things. Next one is cess and surcharge. So these are tax on tax. Cess and surcharge are tax on tax. So how it is calculated? How cess is calculated? Tax on tax, how? So 100 rupees is the income. If 10% is the income tax, then what is the tax? 10. Then on 10 there will be a cess. If that is 10%, then this 10% is only on 10, tax on tax. Now what is the problem? Problem is mainly because of the amount that is cess and surcharge is not going to divisible pool. So there is an increasing cess and surcharge from the sender side. There is an increase in the overall cess and surcharge, and the overall divisible pool is reduced, shortened. This is the challenge. And cess is always for a specific purpose, and it will be through a law. Now 16th Finance Commission is talking about the grant bargain. Now pan masala cess, that is also, you remember, it is a capacity based cess. It is not value, ad valorem, not based on value, it is a capacity based. Means if there is a pan masala industry, what is its capacity? How many packets it will make? That is a capacity. So that will be the basis of taxing it, because it will be difficult to see what is the total output, how many are actually were gone transaction. It will be difficult. So the capacity based cess is imposed on pan masala, whatever we already discussed. So that's it. Now we'll move to monetary policy. So there are a few things like monetary policy, then banking, agriculture, means sectors, infrastructure, international economics. Banks, no? Government. No?
I will read budget from the PDF. Topic: 3 core kartavyas defining the 2026 budget. The 2026 budget is driven by the government Sankalp to focus on the poor, underprivileged and disadvantaged, and is anchored by 3 core kartavyas or duties. First kartavya, to accelerate and sustain economic growth. Second kartavya, to fulfill the aspirations of the people and build their capacity. Third kartavya, to realize the vision of Sabka Saath Sabka Vikas. First kartavya, to accelerate and sustain economic growth. Second kartavya, to fulfill the aspirations of the people and build their capacity. Third kartavya, to realize the vision of Sabka Saath Sabka Vikas. 2026 budget is officially characterized as Yuva Shakti driven budget. The ultimate goal reaching theme is to take confident step towards Vikasit Bharat, that is developed India, balancing ambition with inclusion. The guiding principle: government has explicitly defined its economic trajectory using 3 powerful catchphrases that reflects its policy stance. First one is action over ambivalence. Second one is reform over rhetoric. Third is people over populism. Next topic: India Semiconductor Mission ISM 2.0. Point 1. Nodal Ministry and Implementing Agency, that is Ministry of Electronics and Information Technology. Point 2. Budgetary allocation. Financial year 2026-27 allocation. The specific budget estimate for ISM 2.0 is 1000 crore. Point 3. Paradigm shift. A. ISM 1.0, the past, focused primarily on establishing assembly, testing, marketing and packaging units, that is ATMP units, and basic fabrications. ATMP plus basic fabs. B. ISM 2.0, the future, moves structurally upstream, The core objective is to manufacture the actual chip making equipments and materials. C. IP creation aims to design full stack Indian intellectual property and fortify supply chain against geopolitical disruptions. Point 4. Strategic technology choice. A. Focus on mature node. India deliberately prioritizes older, established, mature node technologies, power and analog chips, rather than directly competing in hyper advanced leading edge logic chips like 2 nanometer, 3 nanometer. Point B. Rationale aligns immediately with massive domestic demand, that is electronic vehicles, telecom, and the 50 gigawatt per year solar energy mission. Point 5. Design linked incentive scheme, DLI scheme. A. Target to build global chip design champions. B. Incentive provided under that: 1. Access to advanced design infrastructure and software tools. 2. Up to 50% reimbursement on eligible product design cost. 3. Deployment linked incentive, that is bonus of 4 to 6% of total sales revenue for 5 years once the chip is successfully manufactured and sold. Point 6. Geopolitical synergy, that is critical minerals. A. Rare earth corridors to achieve true strategic autonomy and secure a raw material for chips. ISM 2.0 is structurally linked with establishment of rare earth corridors in Odisha, Kerala, Andhra Pradesh and Tamil Nadu. This topic is over. Next topic. 3 core kartavyas. Next topic is Electronics Components Manufacturing Scheme, ECMS. Nodal Ministry and Implementing Agency, Ministry of Electronics and Information Technology. Point 2. Basic framework and financials. Under that, a launch date April 2025. It is not a new scheme in the budget 2026-27. Point B. Total outlay nearly doubled to 40,000 crore, up from the original 22,919 crore due to massive investor response. C. Budget estimate for the financial year 2026-27 is 1,500 crore. D. Macro target: build the foundation for a $500 billion electronics manufacturing ecosystem in India by 2030-31. E. Application window open until 2027. Point 3. Geopolitical and strategic rationale. Under that, A. PLI flaw. It is assembly focused. The traditional PLI scheme resulted in low domestic value addition because companies mostly imported ready-made components and merely assembled final products in India. D. Vulnerability. This left India's supply chains highly vulnerable to geopolitical shocks and trade tensions. C. ECMS upgrade, that is deep value addition. It focuses on manufacturing the actual foundational core components, materials and precision tooling locally to build true strategic resilience and reduce import dependence. Point 4. Three pillar incentive structure. Unlike the traditional PLI scheme, which rewarded companies purely on incremental sales, the ECMS structure is broader. Financial incentives are strictly linked to three parameters, that is A. Capital expenditure capex, rewarding companies that invest hard cash into heavy infrastructure and machinery in India. B. Employment generation, explicitly linked payouts to the number of actual formal jobs created. C. Sales target. This topic is over. Next topic. Biopharma Shakti. Biopharma Shakti. Shakti. Point 1. Shakti equals to. Shakti means strategy for healthcare advancement through knowledge, technology, and innovation. Total outlay 10,000 crore over the next 5 years. Current year allocation, that is financial year 26-27 budget, is 500 crore. Key agencies and ministries involved. One is CDSCO, Central Drug Standard Control Organization, functioning under the Directorate General of Health Services, Ministry of Health and Family Welfare. Second one is NIPER, National Institute of Pharmaceutical Education and Research. Point 2. Geopolitical and macroeconomic rationale. A. Strategic shift volume to value. Historically, India has been a global volume leader in producing low-cost generic drugs via chemical synthesis, which heavily depends on China for APIs. This scheme transitions India to a value leader and global innovator. B. Shifting disease burden. The policy is a direct response to India's disease burden shifting from communicable disease to non-communicable diseases. Point 3. Core scientific focus. Biological. First one is biologics. Core scientific focus. A. Biologics. Largely high complex molecules manufactured from living systems or organisms, example plants or animal cells, using biotechnology rather than chemical synthesis. B. Biosimilars. Lower priced, highly similar copies of complex biological drugs whose global patents are expiring because they come from living cells. They are not 100% structurally identical, exact replicas like chemicals, generics, but they produce the same clinical outcomes. Biologics. Largely highly complex molecules manufactured from living systems or organisms, example plants or animals, using biotechnology rather than chemical synthesis. Biosimilars. Lower priced, highly similar copies of complex biological drugs whose global patents are expiring because they come from living cells. They are not 100% structurally identical exact replicas like chemical generics, but they produce the same clinical outcomes. Point 4. The 4 pillars of implementation. A. Institutional research. Establishing 3 new NIPER and upgrading 7 existing ones to foster advanced R&D, research and development. B. Clinical trials network. creating a nationwide network of over 1,000 accredited India clinical trial sites. C. Regulatory upgrades, strengthening the CDSCO by adding a dedicated scientific review cadre to meet global standard and speed up approvals. D. Tax support, fully exempting 17 cancer-related drugs and medicines from basic custom duty to ensure immediate affordability. So next topic, rare earth corridors. Rare earth corridors. Point 1. Target states. The corridor will be exclusively established in 4 mineral-rich coastal states: Odisha, Kerala, Andhra Pradesh, and Tamil Nadu. B. The core mineral. The target resource in these coastal beach sands is monazite. Coastal beach sand is monazite. Point 2. Scientific profile of monazite. A. Composition. A reddish brown phosphate mineral containing rare earth metals, that is cerium, CERIUM, lanthanum, and neodymium, NEODYMIUM. B. Point B. Radioactive link. Monazite is a thorium-bearing mineral that also contains trace uranium because thorium is a radioactive element central to India's nuclear energy program. Monazite mining is heavily regulated and strictly controlled. Point 3. Rationale. A. Breaking the China monopoly. China currently controls 92% of global rare earth refining capacity. India relies on China for its rare earth imports. B. Supply chain resilience. To secure raw materials for frontier sectors like electronic vehicles, wind turbines, aerospace, defense, and the semiconductor mission ISM 2.0. C. Integrated value chain. The corridors are not just for upstream mining, they are integrated zone encompassing the entire ecosystem, that is mining, processing, research, and upstream magnet manufacturing. Point 4. Synergistic schemes and tax SOPs. A. REPM scheme linkage. The corridor synergizes with 7280 crore rare earth permanent magnet REPM scheme, which targets the domestic manufacturing of 6,000 metric tons of super strong magnets annually. Point 5. Recycling potential. Untapped reserve. Recycling e-waste like scrapped EV motors and wind turbines could meet over 35% of India's rare earth demand within a decade. Next topic. 10,000 crore SME growth fund. 10,000 crore SME growth fund. Nodal Ministry and Implementing Agency, Ministry of Finance and Department of Financial Services. Point 2. Macroeconomic philosophy. Debt versus GDP. A problem, that is debt trap. Historically, MSME relied on bank loans, leading to immediate EMI pressure that choked cash flow and forced them to stay small. Voluntary dwarfism. B. Solution equity. The SME Growth Fund provides equity support instead of giving loans. Professional fund managers buy a small percentage of ownership, that is shares, in promising SMEs. Point C. Benefits. Zero EMI burden. MSME can use 100% of the funds for adoption, scaling, and job creation. Point 3. Broader MSME strategy. The SME Growth Fund is the first pillar of budget. New three-pronged approach for MSME are: 1. Equity support, that is 10,000 crore SME Growth Fund. 2. Liquidity support, TREDS, TREDS platform mandates for CPSE for instant invoice discounting. 3. Professional support, corporate mitras to help the regulatory compliance in Tier 2 and Tier 3 towns. Point 4. Companies fund for micro enterprises. Under that, while the SME Growth Fund targets champion small and medium enterprises, the budget also announces 2,000 crore top up to the existing Self-Reliant India Fund, SRI Fund. B. The specific top up is aimed exclusively at maintaining access to risk capital for micro enterprises. Liquidity support, TREDS mandate. Next topic, liquidity support, TREDS mandate, TREDS mandate. TREDS means Trade Receivable Electronics Discounting System. Mechanism: a digital platform for invoicing, discounting. Banks or NBFCs bid on verified MSME invoices, paying the MSME immediately at a discount and collecting the full amount from the buyer later. Regulatory body: it is regulated by the RBI, Reserve Bank of India. Collateral: it provides financial assistance to MSME without requiring any collateral. The four-pronged budget 2026-27 mandate to permanently solve the delayed payment crisis. The government announces 4 specific interventions. First one is mandatory CPSE settlement. TREDS is now the compulsory transaction settlement platform for all purchases made from MSME by central public sector enterprises, CPSEs. B. Credit guarantee via CGTMSE. The government introduced partial credit guarantees through the CGTMSE. If a corporate buyer defaults the bank or NBFC, risk is partially covered, encouraging them to discount invoices freely. C. GEM integration. The government e-marketplace, that is GEM portal, is now directly linked with TREDS, TREDS, to ensure seamless data sharing with financier regarding government procurements. D. Asset-backed securities, ABS. TREDS receivable will be pooled and converted into asset-backed securities. This allows bank to sell these bundled invoices to long-term institutional investors in the secondary market, massively freeing up banking capital to lend again. Next topic, professional support or corporate mitras. The core problem, that is voluntary dwarfism. The compliance burden MSME face a complex point one core problem, that is voluntary dwarfism. Under that, point A, compliance burden. MSME face a complex web of legal and taxation compliances. Hiring a top tier professionals is expensive, leading to a silent cost of doing business. B, the result, many MSME actively choose to remain small and informal to avoid regulatory scrutiny, a phenomenon termed voluntary dwarfism. Point 2, the solution. Who are corporate mitras? A, the profile, a dedicated accredited cadre of para-professionals. B, the role, to provide professional hand holding to small business, helping them meet all and legal comply, or helping them to meet all tax and legal compliance requirements confidently and at affordable cost. Point 3, implementation bodies and training. No direct government hiring. The government will not directly hire these mitras. B, statutory nodal bodies. The initiative is facilitated three apex professional institutions, ICAI and ICSI and ICMAI. That is, ICAI equals to Institute of Chartered Accountants of India. ICSI equals to Institute of Company Secretaries of India. ICMAI equals to Institute of Cost Accountants of India. C, training mechanism. These bodies will design short-term modular courses and practical tools to train and certify this new cadre. Point 4, target geography. Strategic placement. The deployment is explicitly targeted at Tier 2 and Tier 3 towns. Next topic, National Fiber Scheme. Nodal Ministry, Ministry of Textile. The framework, it is newly announced scheme that operates as the first pillar of a new 5-part integrated program specifically designed to upgrade the labor-intensive textile sector. Point 2, core objective. Under that, A, the primary goal is to achieve Atmanirbharata, that is self-reliance in the textile industry's raw material, that is fibers. B, price competitiveness. By building a robust domestic raw material base, it ensures supply stability and price competitiveness for India's manufacturer at the very start of the value chain. Point 3, scope of coverage. The entire spectrum. A, historically skewed towards cotton. India's strategy now broadens to cover the entire fiber spectrum. It provides targeted support for A, natural fiber, that is silk, wool, jute. Second, man-made fiber, synthetic fiber that dominate global fast fashion. Third is new age fiber, that is a new age fiber or technical textile, advanced materials used in defense, medical gear, active wear, and industrial applications. Point 4. Geopolitical and macroeconomics rationale. Under that, A. Supply chain resilience. It mitigates supply chain vulnerabilities and reduces import dependence amidst AMIDST global tariff wars and geopolitical tensions. B. Leveraging FTAs, small s, securing continuous high quality fiber inputs is necessary to effectively utilize free trade agreements FTA being negotiated with regions like UK and European Union. Point C. Global catch up. Ensures India captures the lucrative global shift from traditional cotton towards man-made and technical new age fibers. The broader ecosystem, the other four pillars. To complete the integrated textile program, the scheme works alongside A. Textile expansion and employment scheme, B. National Handloom and Handicraft program, C. Text Eco initiative for green and sustainable production, D. Samarth 2.0 for worker skilling. Next topic, National Container Mission or Container Manufacturing Assistance Scheme. Point 1. Implementing Ministry of Ports, Shipping and Waterways. Point 2. Financial outlay and target. Budgetary allocation, a dedicated corpus of 10,000 crore over a 5-year period. Manufacturing target aims to create an annual domestic manufacturing capacity of around 1 million 20-foot containers over the next decade. 1 million 20-foot containers. Point 3. Macroeconomics and geopolitical rationale. Breaking the Chinese monopoly. First one is breaking the Chinese monopoly. Second is plugging forex leakage. India currently imports nearly 2 million empty containers every year. Next is cost efficiency. Economic estimates suggest that if manufactured domestically in India, the cost will be nearly 25% cheaper. Next topic, 7 high-speed rail corridors. Under that, point 1, basic framework and financial scale. Implementing agency, Ministry of Railways, project scale. Development of 7 new high-speed rail corridors spanning a total length of 4,000 kilometers. Next point, 7 routes. The Southern High-Speed Triangle or Diamond 5 corridors interlinks major southern and western economic or IT hubs. That is, one is Mumbai to Pune, second Pune to Hyderabad, third Hyderabad to Bangalore, fourth Hyderabad to Chennai, fifth Chennai to Bangalore. Northern and eastern connectors, 2 corridors, Delhi to Varanasi and Varanasi to Siliguri via Patna, connects UP, Bihar, North West Bengal. Next point, growth connectors. officially termed as such to act as economic multipliers, facilitating education, health, and business between regions. Environmentally sustainable, pushed as an eco-friendly, low-carbon alternative to road and air passenger travel. Next point, spatial strategy or agglomeration economics. By linking tier 2 and tier 3 cities to metros, it creates satellite housing markets, decentralized growth to peripheral areas, and reduces severe congestion cost in existing metropolitan cores. CORES. Next topic, dedicated freight corridors. Nodal ministry and implementing ministry, that is Ministry of Railways. Route connects Dankuni in West Bengal to Surat in Gujarat. 2052 kilometer long corridor. Objective to promote environmentally sustainable cargo movement, reduce transit time, and seamlessly integrate the eastern network with existing western freight corridor. Eastern dedicated freight corridors. Route Sahanewal in Punjab to Sonagar in Bihar. Western dedicated freight corridor route Dadri in Uttar Pradesh to Jawaharlal Nehru Port Terminal in Navi Mumbai. Next point, decongestion. Shifting cargo to DFC frees up standard tracks for passenger trains and has successfully doubled the average speed of freight trains. Next point, modal share recovery. India's rail freight share dropped to 25% by 2020 but has recently recovered to 27% in 2025 due to dedicated freight corridor operationalization, DFC of operationalization. Next point, national rail plan target. The ultimate official target is to increase the railway share of total freight movement to 45% by the year 2030. Next topic, city economic reasons. Next topic, city economic regions. Implementing Ministry of Housing and Urban Affairs. Core concept. Point to core concept. Moves away from viewing cities purely by their isolated administrative or municipal boundaries. It treats a cluster of cities, towns, and their surrounding hinterlands as a single networked economic ecosystem. Next point, deburdening metros. The core spatial spatial strategy is distributed growth to steer investments. Steer investments into peripheral and shadow areas, thereby reducing the severe congestion costs that plague existing metropolitan cores. CORES. Next point, the allocation. Government will allocate 5,000 crore per CER over a period of 5 years. Next point, execution mechanism. in challenge execution mechanism, that is challenge mode. These are not unconditional statutory grants. Funds will be unlocked strictly through a challenge mode with a reform come result based financing mechanism. Cities must submit joint proposals and undertake specific municipal governance or balance sheet reform to get money. Cities must submit joint proposals and undertake specific municipal governance or balance sheet reform to get money. Next point. The 7 identified CERs. First, Bangalore. Second, Surat, Varanasi, Vishakhapatnam, Pune. Next, Eastern Tri-City, that is Bhubaneswar, Puri, Cuttack. Next, Southern Tri-City, that is Coimbatore, Erode, ERODE, and Tirupur, TIRUPPUR. Connectivity and sustainability vectors. First one, alignments. CER will require the deliberate alignment of transport, land use, skill development, and municipal finance across the region. Next point, growth connectors. To link these economic hubs, the government is developing the newly announced 7 high-speed rail corridors as environmentally sustainable growth connectors. Climate resilience. The resulting infrastructure must be strictly low carbon and climate resilient. Next topic, infrastructure guarantee fund. Financial size, that is corpus. Early estimate suggest a planned fund size of 25,000 crore. Next point, no direct lending. The fund does not give direct loans to private developer. Next point, partial credit guarantees, that is PCG. It provides prudently calibrated partial credit guarantee to lenders, that is banks and financial institutions who finance infrastructure projects. Next point, first loss protection. First loss protection. It operates as a safety net. If project fails or faces a severe hurdle, the government fund absorbs the initial financial loss up to a certain limit, protecting the lending bank's balance sheet. Next point, the target phase. The guarantee is explicitly aimed at the highest risk period of a project, the development and early construction phases. Next point, solving the asset liability mismatch. Commercially, banks hesitate to fund infrastructure because they rely on short-term public deposits, whereas infrastructure requires 15 to 20 years long-term loans. This fund gives banks the security to bridge this mismatch. Next point, macroeconomic impact. By de-risking the loans, banks can offer lower interest rates, thereby significantly lowering the overall cost of capital for developers. This boosts PPP, public-private partnerships, and helps finance complex urban projects like newly announced City Economic Regions CER. Next topic, Bharat Visthar. Bharat Visthar. Visthar means virtually integrated system to access agriculture resources. It is a newly proposed multilingual artificial intelligence tool designed to provide customized real-time advisory support to farmers. Implementing agency or Ministry of Agriculture and Farmer Welfare with the support from Ministry of Electronics and Information Technology. Budgetary allocation. Initially allocation of 150 crore for the first year in budget 2026-27. Next point, technological backbone. Integration the system functions by seamlessly integrating two massive digital pillars. First one is AgriStack portals, the digital infrastructure containing farmers' digital identities, georeference land records, growth registries and early warning systems. Next is ICAR practices, the Indian Council of Agriculture Research package of validated scientific practices. Next point, eliminating digital red tape. Act as a single unified digital companion to prevent farmers from juggling multiple apps. Next point, modes of access. Farmers can access the AI system via an Android app, website, AI chatbot, or simply by calling a toll-free helpline, that is 155261, using a basic keypad phone. Next point, localized output. The AI cross-reference the farmer's AgriStack profile with scientific data and market intelligence to generate highly specific real-time solutions delivered accurately in the farmer's local regional dialect. Next point, decision grade intelligence replaces generic one size fits all advice with precise instructions. Example, exact pest management for a specific crop in a specific village, helping farmers reduce risk and boost productivity. Next point, synergy with high value crops. Essential for supporting the budget push towards high margin, high risk plantation crops like cashew, cocoa, and sandalwood, which demand precise field specific intelligence to succeed. Next topic, high value crops. Point, total allocation 350 crore specifically allocated for high value agriculture for financial year 26-27. Macroeconomic rationale, volume to value. Because next point, volume to value, because productivity in traditional crop, that is cereals or pulses, has stagnated. The policy decisively shifts focus to high margin plantation and tree crops to enhance farmer incomes. Next point, import substitution. India currently faces a massive import burden in this sector, importing nearly 100% of its almond, over 50% of its cashew and walnuts, facing a massive cocoa deficit. Next point, tech synergy. Because high value crop carry higher risk requiring precise timing. This push is directly synergized with Bharat Vistar. Next point, coastal areas. Coconut, sandalwood. No. Next point, geographical mapping. Under that, point A, coastal areas, coconut, sandalwood, cocoa, cashew. B, hilly regions for almond, walnut, pine nuts. C, northeast region for agar trees. Coastal areas for coconut, sandalwood, cocoa, cashew nut. Hilly regions for almond, walnut, pine nuts. Northeast region for agar trees. Targeted schemes. Under that, a coconut promotion scheme fund 125 crore targets coastal states to replace senile, old and non-productive trees with new high yielding pest resistant sampling. B, cashew and cocoa program, a dedicated push to make India self-reliant in raw production and transform Indian cashew and cocoa into premium global brands by 2030. C, Indian sandalwood ecosystem. The centers will partner with states to promote cultivation and post-harvest processing to restore its cultural glory. D, hilly region nuts. Support for the high density cultivation and rejuvenation of low yielding walnut, almond and pine nuts orchards. Orchards. Next topic, VBG Ramji replaces MG Narega. VBG Ramji replaces MG Narega. Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin, or VBG Ramji, is arguably the most fundamental shift in India's rural policy in the last 2 decades. Legal basis. Statutory backing. VBG Ramji Act 2025 received presidential assent in December 2025, officially repealing and replacing the 2-decade-old MGN-REGA Act 2005. Implementing Ministry of Rural Development. Next point, core structural change. Under that, A, increased work guarantee. The statutory guarantee of wage employment has been expanded from 100 days to 125 days per rural household per financial year. Point B, the funding paradigm shift. Under the old MGN regs, the center bore 100% of the unskilled wage cost. Under VBG Ramji, it is centrally sponsored scheme with shared financial liability. The funding is split 60:40, center 60, state 40 for general state, and 90:10 for northeast and Himalayan regions. Budgetary allocation for 2026-27. Total rural job allocation is 1.26 lakh crore. BBG Ramji allocation receives the bulk of the funding with a massive 95692 crore. Next point, transition window, MGNREGA is not scrapped overnight. A sum of 30,000 crore is allocated to the old MGN regs, specifically to clear pending dues and fund ongoing works during a 6-month transition window. Next point, supply driven and decentralized. It shifts from a poorly demand driven model to supply driven. Work is identified through village level plans decided by Gram Sabhas and Panchayats. Any expenditure beyond the central normative allocation is now the state's responsibility. Next point, asset creation focus shifts away from scattered manual labor towards 4 priority verticals, that is water security, core infrastructure, livelihood infrastructure, and climate resilience. Next point, harvest pause period. Introduced a 60-day suspension period during peak agricultural sowing or harvesting season to prevent farm labor shortage. Next point, tech integration utilizes an infrastructure stack, AI, biometrics, and geospatial tracking, and integrates with PM Gati Shakti for national level planning. Next point, administrative cap increased from 6% to 9% to allow the hiring of more technical staff and engineers. Next point, the rationale. By forcing states to bear 40% of the costs, center aims to bring efficiency. Next topic, PM Viksit Bharat Rozgar Yojana. PM Vikasit Bharat Rozgar Yojana. Origin. It is the renamed and continued version of Employment Generation Scheme announced in Budget 2024-25, forming a part of PM Special Package for 21 million youth over 5 years. Budgetary allocation of 20,083 crore for the financial year 26-27. Core concept, that is employment linked incentive. Under that, A strategy, shift away from direct government job creation to an employment linked incentive model. The goal, subsidized the initial cost of hiring to nudge the private sector into hiring fresh graduates and bringing youth into the formal provident fund paying economy. Next point, 2-part incentive structure. Under that, part A, for the employee, the joiner incentive. Youth landing their first job in the formal private sector, first time EPFO joiners, a direct one-time government support of 15,000. Part B, for the employer, the hiring incentive. Government pays up to 3,000 per month per new employees to the employer. Government pays up to 3,000 per month per new employee to the employer. Strict compliance rules. Under that, salary cap. Only employees earning less than 1 lakh per month are eligible. Next topic, Pradhan Mantri Awas Yojana. Next topic, Pradhan Mantri Awas Yojana. Point 1, vision. Housing for all, providing a Pakka that is permanent house with basic amenities, that is water, electricity, toilets to the homeless and those in dilapidated houses. The two components are PMAY Urban. PMAY Urban, implemented by Ministry of Housing and Urban Affairs, launched in 2015. Next component, PMAY Gramin, implemented by the Ministry of Rural Development, launched in 2016 by restructuring the Indira Awas Yojana. Next point, mandatory ownership. PMAY is fundamentally engineered as a tool for gender justice and wealth redistribution. It strictly mandates that the female head of the family must be the owner or co-owner of the house. Next point, PMAY Gramin specifics. Under that, beneficiary, deprived household identity. Point is PMAY Gramin. Under that, A, beneficiaries, deprived households identified via socio-economic and caste census 2011 data and verified by the Gram Sabha. Funding ratio 60:40. In plain areas, 90:10 for Northeast and Himalayan state, 100% central funding for UTs. Financial year 2027 allocation 54,917 crore. Next point, PMAY Urban, beneficiary, economically weaker section, EWS, lower income groups, middle income groups who do not own a Pakka house anywhere in India. Financial year 2027 allocation 18,624 crore, 18,624 crore to 22,025 crore, representing a massive 179% jump over the previous year's revised estimate. Next topic, Divyangjan Kaushal Yojana. Divyangjan Kaushal Yojana, implementing Ministry of Social Justice and Empowerment. Next point, livelihood push. It is designed to provide dignified livelihood opportunities to persons with disabilities or Divyangjan. Next point, customized training. It shifts away from generic skilling by providing customized industry relevant training that is specifically tailored to the needs of each disability group. Next point, the target industries. The scheme explicitly targets sectors like IT, AVGC, that is animation, visual effects, gaming and comics, hospitality, food and beverages. Next topic, Divyangjan Sahara Yojana. PM Divyangjan Sahara Yojana. Point 1. Make it easy and affordable for Divyangjan to get modern assistive tools that help them live and work independently. Next point 2. PM Divyasha Kendras and Assistive Technology marts of these models are explicitly designed to serve both Divyangajan, that is persons with disability, and senior citizens. Next point, PM Divyasha Kendras. These are service hubs. Next point, assistive technology marts. These are retail experience. Next point, instead of subsidizing import, the scheme mandates domestic capacity building. Alimco, ALIMCO, is being supported to heavily scale up local production, invest in R&D, and natively integrate artificial intelligence into assistive devices. Next topic, She Mart. She Mart, SHE Marts. Full form, self-help entrepreneur marts. Next point, community owned, community owned retail outlets designed specifically for rural women led enterprises. Next point, these are not stand-alone government-run shops. They will be established directly within the existing cluster-level federations of self-help group ecosystem. Next point, credit to ownership. The incentive marks a fundamental policy shift from traditional welfare oriented interventions and credit led livelihoods to active enterprises ownership and women centric economic participation. Next point, market democratization solves the core problem of market access and branding for rural women, bringing them into formal and global supply chain. Next point, innovative financing. Instead of relying solely on traditional debt, She Marts will be funded through enhanced and innovative financing instruments to help women secure capital without traditional collateral roadblocks. Next point, digital and global integration provides a physical platform for local sales while digitally linking women's manufactured goods to broader e-commerce and global markets. Next point, She Mark, supported by a specific She Mark identity framework to help brand and distinguish women-led products, ensuring high quality manufacturing standards. Next point, Lakpati Didi 2.0. She Marts are built directly upon the success of the Lakpati Didi program to help these women sustain and scale their incomes. Next topic, STEM hostels for women. The government will establish exactly one girls' hostel in every single district across the country. These hostels are meant for higher education STEM, that is science, technology, engineering, and mathematics institutions. Next point, practical rationale behind it. Under that, A, laboratory hurdles. Pursuing higher education in STEM disciplines inherently requires prolonged hours of study and laboratory works. B, safety access. These irregular hours pose severe commuting and safety challenges for female students, especially from rural or peri-urban background. The policy aims to ensure that a girl's merit should never be defeated by the lack of hostel room. Next point, viability gap funding VGF. The government will not bear the indefinite 100% operational cost. The hostel will be established through viability gap funding or capital support, likely in public private partnership mode, providing a one time capital grant to make construction financially viable. Next point, a U shaped curve. U hypothesis pushing female higher education may cause a temporary dip in the female labor force participation rate as women withdraw from informal work to study. However, it creates a U-shaped curve as these women eventually return to the formal workforce as high skilled individuals in high paying sectors. With this, budget topic is over. Now I will read the PDF from the chapter taxation. New Income Tax Act. Topic 1, New Income Tax Act. Topic is New Income Tax. New Income Tax Act 2025 officially replaces the complex 6-decade-old Income Tax Act of 1961. It will come into legal effect prospectively from 2026 April 1. Three principles are: A. Textual and structural simplification. B. No major tax policy changes, ensuring continuity and certainty for businesses. C. No modification in tax rates. The confusing dual terminology of the previous year and assessment year has been completely abolished. These have been replaced by a single unified term called tax year. Revised returns. The deadline for filling the revised tax return has been extended to March 31, giving taxpayers 12 full months after the end of tax year to fix mistakes. Next point, updated returns. Taxpayers can now file an updated return to declare additional income for up to 4 years from the tax year. Next point, the maximum punishment under the act has been reduced from 7 years down to 2 to 3 years. Reduced from 7 years, that is old. New is 2 to 3 years. Next point, for cases where the tax evaded does not exceed 10 lakh, there will be no jail term, only a monetary fine. Next topic, minimum alternate tax, MAT. MAT was originally designed to ensure that zero tax companies which report massive book profits but whose exemptions to wipe out their taxable income and pay a minimum baseline tax The overhaul is to nudge companies out of the old exemption heavy regime and into the new simplified 22% concessional corporate tax regime. Next point, rate cut. The base MAT rate levied on book profit has been reduced from 15% to 14%. Next point, shift to final tax. MAT will now operate as a final tax liability. Next point, no new credits. Starting April 1, 2026, the cycle of accumulating and carrying forward new MAT credit will completely ceases. Next point, old regime. If a company chooses to remain in the old tax regime to keep its exemptions, all of its previously accumulated MAT credits will permanently lapse. Next point, migration incentive in a new regime. To save legacy credits, a company must migrate to the new tax regime. Migrating companies can use their old MAT credit offset up to 25% of their tax liability in any given year within the existing 15 years carry forward window. Next topic, share buyback. A share buyback is when a company uses its cash to buy its own shares back from existing shareholders, often at a premium to return excess cash or signal that shares are undervalued. Next point, under the previous 2024 rules, the entire amount received by an investor from a buyback was treated as dividend income. This was taxed at higher personal income tax slab rates, and the original cost of buying the share could not be deducted from this amount. This unfairly penalized retail and minority shareholders. Next point, shift to capital gains budget 2026-27. Under that, new classification, buyback proceeds will no longer be treated as dividends. They will now be taxed purely as capital gains. Next point, fair computation, fair computation, COMPUTATION. The taxable amount is now simply the profit, the consideration received buyback price minus the cost of acquisition, that is original purchase price. Next topic, GST 2.0. GST 2.0 is a sweeping structural reform that simplified India's indirect tax regime from a multi-tier system to growth-oriented rationalized model, implemented from September 22, 2025. Next point, rate rationalization in new slabs. Under that, the complex 4-tier structure, that is 5%, 12%, 18%, 28%, has been scrapped and replaced with simplified 2-slab structure alongside a special demerit rate. Point B, 5% merit rate covers most of most of items previously in the 12 slab includes daily use items, agriculture inputs, healthcare products, ready-made garments, footwears below 2,500 rupees. Point C, 18% standard rate. The primary revenue anchor, major consumer durable, ACs, TVs, refrigerator, small cars, shifted down from 28% slab to 18%. Point C, 40% special demerit rate, exclusively reserved for luxury and sin goods like aerated, caffeinated drinks, large SUVs, and online real money gaming. Point E, special retained rates, uncut diamond 0.25%, cut or polished diamond 1.5%, gold silver 3% remain unchanged. Next point, healthcare and insurance. 36 essential or cancer drugs are individual healthcare and insurance. Under that, 36 essential or cancer drugs and individual health and life insurance premiums are now fully exempted, that is 0% from GST. Group corporate insurance policies remain taxable. Next point, GST-80 operationalized. The GST Appellate Tribunal is now active to resolve dispute. Each bench strictly balances power with two judicial members, one technical member from center and one technical member from state. Appeals require 10% pre-deposit. Next point, inverted duty structure relief. To resolve working capital blockage where tax on input is higher than the final product. Section 54 clause 6. Section 54 clause 6 now allows 90% provisional refund for IDS cases within 7 days. IDS means inverted duty structure. Next point, fiscal impact. Under that, the rate cuts cause an immediate revenue loss of 45,000 to 48,000 crore in the financial year 26. Next point, the center expects to offset this loss through a consumption boost that could add 100 to 120 basis point to GDP growth and lower retail CPI inflation by 25 basis points. 20 to 25 basis points. Next point, compensation cess abolition. The GST compensation cess to states has been completely phased out and abolished in the budget 26-27. Next topic, security transaction tax, that is STT. STT is fundamentally classified as direct tax. It operates structurally similar to tax collected at source, that is TCS. It was introduced in 2004 specifically to curb tax evasion on capital gains from buying and selling securities. Applicability. It is levied exactly at the time of purchase and sale of securities. Next point, applies to tradable investment instruments like shares, equity oriented mutual funds, and equity derivatives. STT exclusively applies to securities that are listed on recognized stock exchanges in India. Next point. Transactions executed in the Gift City International Financial Service Center IFSC are explicitly exempted from STT. Next point. The Union Budget 2026-27 heavily rationalized and increased STT rates, specifically targeting the derivatives, that is, futures and options market effectively April 1, 2026. Next point, futures. STT on the sale of futures hiked from 0.02 to 0.05%, calculated on the total contract value or notional turnover. Next point, options, that is premium. STT on the sale of options hiked from 0.1% to 0.15%, calculated only on the premium value, not the whole contract. Next point, economic rationale. The primary intent of this massive hike was not revenue generation but to act as a deterrent to curb high risk speculative fraud by retail investors and protect household savings. Next topic. Taxation and regulation of virtual digital assets. Taxation and regulation of virtual digital asset. VDA. Any information, code, number or token generated via cryptography or otherwise that is transferred or stored electronically. It explicitly includes cryptocurrencies, bitcoins, Ethereum, and non-fungible tokens. Property status, that is IT Act 2025. Cryptocurrencies are now formally classified as property and a capital asset, placing them in the same statutory category as land, bullion, or art. India taxes VDA, virtual digital asset transactions, but this does not mean they are legalized or regulated by bodies like SEBI. Next point, profits are taxed at a punitive flat rate of 30% plus surcharge and 4% cess. No loss set offset. Losses cannot be set off against profits from another VDA or other income. Next point, 1% tax deducted at source applies to transfer to create a transaction trail. Next point, GST is also strictly applicable on exchanges. Next point, enforcement under Income Tax Act 2025. Under that, access to virtual digital space. During raids, tax authorities now have explicit statutory power to access a suspect's remote cloud server, email, and online trading accounts by legally overriding any passwords or access codes. B. Expanded undisclosed income. The definition of undisclosed income, that is previously limited to physical money, bullion, or jewelry, now explicitly included VDA. Next point, C. Compliance penalties. Under section 509, exchanges or intermediaries face a 200 per day penalty for delayed statements and a flat 50,000 penalty for penalty for inaccuracies. Next point, anti-money laundering AML and FIU IND oversight. Under that, A, reporting entities, virtual asset service provider and exchanges, both offshore and onshore must register as reporting entities under the Prevention of Money Laundering Act PMLA with FIU IND. Next point B, strict KYC. Exchanges must use the penny drop method for bank verification, live selfies to stop deep fakes, and log precise geolocation coordinates. Next point, the CARF integration. India has adopted the OECD led Crypto Asset Reporting Framework CARF. Automatic cross-border sharing of crypto transactions data begin on April 1, 2027. Next topic, double taxation avoidance agreement. Double taxation avoidance agreement, that is DTAA. DTAA. It is a bilateral tax treaty between two countries designed to allocate taxing rights and prevent an investor's income from being taxed twice. Next point, the new Income Tax Act 2025 retains the core provisions that allow the government to frame these tax treaties. Next point, enforceability. Section 90 mandates DTAA does not automatically become enforceable in India upon signing. The Supreme Court ruled that notification under Section 90 Clause 1 of the Income Tax Act is mandatory condition for courts or tribunals to give the treaty effect. Next point, the Supreme Court has clarified that DTAA provisions supersede domestic tax laws regarding tax deducted at source, that is TDS. Example, under Section 206AA, failing to provide a PAN usually attracts a punitive 20% TDS. However, if the foreign recipient is eligible for DTAA benefit, the tax authorities cannot demand 20%. The lower statutory cap specified in the DTAA prevails. Example, 10%. Next point, treaty shopping. Treaty shopping, the practice where multinational corporations route funds through shell or mailbox entities in tax havens like Mauritius or Singapore solely to exploit favorable DTAA and avoid taxes. Next point, historically, a tax resident certificate TRC was used as absolute proof to claim DTAA exemptions. However, following the landmark Tiger Global Supreme Court case, a TRC is only prima facie evidence. Tax authorities can disagree the TRC if the entity lacks commercial substance. Next point, head and brain test. Supreme Court checks where the actual control and decision making of a company lie. If the head and brain are outside the treaty country, that entity is deemed a mere see-through conduit. Mere see-through conduit. Next topic: equalization levy or Google tax. Informally known as Google tax, it is direct tax introduced to tax the digital presence and revenues of non-resident multinational tech companies like Google and Meta. Next point: it strictly targets foreign digital e-commerce platforms that generates revenue from India without having a physical footprint or permanent establishment in the country. Next point: it was India's primary weapon to combat base erosion and profit shifting (BEPS), a practice where digital giants move profits to low tax jurisdictions, costing the Indian Exchequer billions annually. Costing Indian Exchequer billions annually. Next point: initially introduced via the Finance Act 2016 as a 6% levy, specifically targeting online advertising. Next point: the scope was later expanded by the Finance Act 2020 to include broader e-commerce supplier and services, attracting a 2% levy. Next point: the central government has proposed to completely abolish the equalization levy effective from April 1, 2025. Next point: the equalization levy gone, India will continue to tax foreign digital firms under the Significant Economic Presence (SEP) rules. Next topic: Global BEPS framework and global minimum tax. Base erosion and profit shifting (BEPS) refers to shifting refers to strategies where multinational corporations (MNCs) exploit gaps in international tax rules. They artificially shift their profits from high tax countries where real economy value is created to low tax or zero tax jurisdiction, that is tax havens. This allows corporate giant to dodge DODGE fair taxation, effectively eroding the tax base of the countries where the revenue was actually generated. The next point: OECD or G20 global minimum tax. Pillar 2: OECD or G20 global minimum tax, that is pillar 2. To combat BEPS, the OECD G20 inclusive framework introduced a landmark multilateral agreement in 2021, that is the 15% floor. The core of pillar 2 impose a minimum effective global tax rate of 15% on corporate profits. Next, the framework strictly applies to massive multinationals with a global revenue of at least 750 million euros. Next point: if a multinational pays a tax rate lower than 15% in a tax haven, the countries where it actually operate can levy a domestic top-up tax to bridge the gap and ensure the 15% threshold is met. Next point: country by country reporting. To ensure compliance with BEPS norms, India is amending laws to make country by country reporting mandatory for Indian multinationals effective from April 1, 2026. Next topic, the paradigm shift from deficit targeting to debt to GDP anchor. In that point, old anchor under the Fiscal Responsibility and Budget Management FRBM Act of 2003, India's fiscal policy was rigidly anchored to fiscal deficit target of 3% of GDP. Next, 2018 review. NK Singh Review Committee later recommended capping the general government debt at 60% of GDP, divided into 40% for the center, 20% for the states. Next point, new anchor. Starting from financial year 26-27, government is abandoning the rigid annual fiscal deficit percentage as its primary anchor. Instead, it will use the debt to GDP ratio. Next point, exact target. The central government aims to place its debt on a declining trajectory, targeting 50% plus or minus 1% of GDP by the year 2031, that is financial year 2031. Next point, currently the central debt is estimated at 55.6% for the financial year 26-27. Next point, debt sustainability depends on the gap between normal interest rate the government pays on borrowing and the nominal GDP growth rate. Next point, if the nominal economy grows faster than the cost of borrowing, the economy can naturally grows its way out of debt even while running moderate deficits. Next point, active bond switching, replacing short duration sovereign bonds with long duration papers to delay repayment maturity and ease immediate fiscal pressure. Next point, Public Debt Management Authority PDMA, a proposed reform to separate public debt management from the RBI, allowing the central bank to focus purely on inflation targeting. Subsidy rationalization. Next point, subsidy rationalization, curbing leakages and improving tax compliance to ensure borrowed money isn't wasted on consumption. Next topic, RBI. Next topic, RBI surplus transfer. Because the RBI is a central bank without commercial shareholders, the money it transfers to the government is legally and technically termed as surplus transfer. Next point, statutory mandate. The transfer is explicitly mandated by the RBI Act 1934. After meeting operational expenses and setting aside contingency provisions, the remaining profits must be given to the central government. Next point, in the union budget, this massive transfer is strictly classified under revenue receipt as non-tax revenue. Next point, the RBI generates massive income through its routine central banking operations, primarily from three sources. First one, foreign currency assets. earning interest by investing its foreign exchange reserves into foreign bonds like US Treasuries. Second, foreign government securities, that is GSECs. SECs, SECS, earning interest on the domestic government bonds it holds. Third one, forex market interventions. The RBI buys and sells US dollars to prevent extreme volatility in the rupee. Next point, economic capital framework, ECF. Before transferring any surplus, the RBI must secure its own financial stability to act as the lender of last resort. Next point, contingent risk buffer, CRB. This is a specific financial reserve the RBI maintains to guard against unforeseen economic crisis, banking failure, or currency fluctuations. Next point, Bimal Jalan Committee 2018. This committee originally recommended that the CRB, that is contingency risk buffer, maintained within a strict range of 5.5% to 6.5% of the RBI's balance sheet. 5.5 to 6.5%. Next point, the historic 2024-25 shift. The RBI Central Board recently widened this CRB range to a broader band of 4.5 to 7.5%. Next topic, cess and surcharge. Cesses and surcharges are additional levies imposed over and above the regular base tax rates. Under Article 270 of the Constitution, the revenue generated from cess and surcharge belongs exclusively to center. Next point, exclusive to center. Okay, next point. Crucially, cess and surcharge are explicitly kept outside the dividend pool of taxes. This means their proceeds are retained 100% by the union and are not mandatorily shared with the states. Next point, a cess is rigid and purpose specific. It must be used exclusively for designed purpose for which it is levied, example, education, health. Next point, regular taxes go directly to the Consolidated Fund of India for use. Cess collection must first be credited to Consolidated Fund of India, but the government is legally required to transfer them into specific dedicated reserve fund. Next point, 16 Finance Commission related points. Under that, point A, because cess bypass the divisible pool, the actual share of taxes going to states dropped. States demanded that Finance Commission 16 cap these levies or include them in the divisible pool. Point B, Finance Commission 16 dismissed the state's demand to share or cap cess, stating it is neither permissible nor desirable under the Constitution. Point C, Grand Bargain. Finance Commission 16 proposed a structural compromise where the center agrees to merge a large part of existing cess or surcharge into regular shareable taxes. In exchange, states must accept a smaller percentage share of this newly expanded divisible pool, ensuring no absolute revenue loss to either side. Next point, Health and National Security Cess, that is Pan Masala. This is capacity based excise cess levied on the machinery or packing speed, not an ad valorem tax on the retail price. With this, we have completed taxation chapter.